Good morning, everyone. It is Wednesday, January 18th here in New York City. This is Yahoo Finance Live. I'm Brad Smith alongside Jared Blickery in studio. Julie Hyman and Brian Sazi are standing by in Davos. We're going to hear from them in just a little bit, but right now, let's get to everything you need to know as the clock strikes 9 a.m. A somber mood from the world's elite. High inflation and high interest rates. They are leaving the world leaders concerned about a looming recession.
That's right.
It's a world of mega threats or polycrisis. Doesn't matter how you call it.
Everyone's talking about recessions.
There will be parts of the world that go into recession.
We're going to be live on the ground in Davos with interviews including KPMG CEO Paul Knopp and the economist dubbed Dr. Doom, Nouriel Roubini. You do not want to miss that. Plus, an industry plagued by layoffs. Microsoft and Amazon, just the latest tech giants, expected to announce more job cuts. We've got the details for you there. And, of course, a check on the markets. Futures this morning are pointing higher across the board on the back of that retail sales report. Let's start there with Jared Blickery, who's standing by at the Wi-Fi Interactive. Jared.
That's right. The December number coming in a drop of 1.1%. That's after a drop of 1% in November. So maybe the holiday season wasn't what it was cracked up to be. Taking a look at our retail space, consumer discretionary has been the strongest sector this year. But guess what, Brad? We got a Party City bankruptcy we're going to talk about in a little bit. Also want to get to some inflation numbers we got this morning on the producer front. This is PPI. The medium estimate came in at negative 0.1%. And guess what? The BLS said that final demand producer prices, they rose 0.2%. So all in all, we're getting a little bit of good news on the inflation front, but definitely not in the retail space, Brad.
Yeah, and so let's dive further into that report, Jared, and I'll kind of bring you back over to the desk for this conversation because, I mean, when we really break down some of the numbers and go into this report on the retail sales front, some of the areas that inflation remained high and actually ticked up a little bit here in terms of the month-over-month change and even the 12-month total where that still remains elevated. Of course, on the 12-month total, you're going to see those highs in gasoline stations. You're still going to see those highs in some of the areas like food and beverage stores. But then you take a look at some of the month over month and what's taken place there. And I think that's exactly where the Fed is going to be looking towards to see exactly how some of the mechanisms that they put in place from a policy standpoint are starting to take effect. And the retail sales number that falls is something that they're going to want to see alongside some of their other core inflationary benchmarks that they're tracking up against in order to really determine the policy going forward from here and whether we get some type of pause in their strategy this year.
I think it's ironic, Brad, that with all the bad data out, we're still in a bad news is bad news environment because the Fed, Jerome Powell, has not flinched. He takes a look at these numbers. I have to think that even given the last CPI numbers that moderated with the headline number to a 6 handle, the food and energy number, those taken out with a 5 handle, you put all that together, still well above that 2% threshold. But let's move on because we've got a lot to take care of here. Microsoft reportedly planning to announce more layoffs as soon as today, ahead of its earnings next weekend. The tech giant is looking to cut around 5% of its workforce. This could mean more than 10,000 job cuts, and that's according to multiple reports. Now, this move comes as waves of layoffs are impacting the entire tech industry, with Amazon job cuts scheduled to begin today. And Brad, this is the trend that we saw emerging last year. I don't know that anybody's shedding tears for a software developer who's making $500,000 a year. These guys can easily get rehired most times. We're not talking about some of the lower skilled workers, but nevertheless, a sign of the times. And layoffs begin in the tech sector first.
Yeah, and when we take a look at some of the logos there on the screen, it really points out how the tech industry had more of the outsized, in fact, the most outsized impact last year across some of the headcount reductions that had taken place. And that's certainly in this kind of ripping off of the Band-Aid early in 2023 that we've seen from companies just trying to be more transparent with the necessity of having that data that they can disclose ahead of time to the street, ahead of what may be a shallow or a mild recession. Within some of that cost restructuring, headcount is one of the top things. You also see them pull back on some of their marketing efforts. But just to put some numbers on this, that there was actually a look at this from Challenger Gray and Christmas. Tech job cuts during 2022, they were up 649% from the figure in 2021. And so it totaled more than 97,000 that had been kind of reported by these companies and disclosed. And so now going forward from here, there is this larger question of if you do see seat count compression from some of the cloud companies, if you do see some of the marketing spends continue to either abate or subside in some areas of their biggest spenders, what does that mean for them being able to retain some of that talent? And where could we see some quiet hiring for that tech talent that is now looking for those positions, as you were mentioning too?
Quiet hiring sounds better than quiet quitting. I mentioned an example a few minutes ago, but overall in 2021, there was massive headcount increase, and guess what? Sometimes you got to dial things back. But there's a reshuffling of the deck right now. Yeah. All those laid off tech workers, they're going to find jobs pretty soon. I'm fairly confident of that.
I'm confident as well. Let's head on over to Davos, where Yahoo Finance's Julie Hyman and Brian Sazi are at the World Economic Forum getting a pulse on how global leaders are prepping for 2023. They're speaking with a number of global leaders and executives across industries, and right now they're sitting down with KPMG U.S. CEO Paul Knupp. You guys take it away.
Hey, Brad, thanks so much. Yes, we are indeed on the pulse of things here at the World Economic Forum here in Davos. Joining us now is KPMG CEO Paul Knupp. Paul, always nice to see you. Set the record straight for us. Some CEOs are saying we're in a recession. Others are saying we're headed towards one. Some say, hey, it's still growing out there. How do you see it?
I do not think we're in a recession in the U.S., Brian. I actually see some pillars of strength in the U.S. when it comes to innovation, technology. The Inflation Reduction Act actually also help with respect to spending in the U.S. You know, there's no doubt that there are challenges too when it comes to interest rates and inflation, but I am personally optimistic that there may not be a recession, or if there is one, it'll be short and shallow.
What are you seeing in terms of spending patterns from your clients, but also what you're hearing from your clients? Obviously, we've heard a lot from the tech sector specifically. We've also now had some job cuts happening in the financial services sector. Are you seeing sort of patchy slowdown, or how would you characterize it?
Well, in the financial services sector, some of those job cuts relate to the deal market being very soft right now. There's no doubt about it, and I expect that to rebound pretty quickly when the deal market rebounds. I would expect the deal market may rebound in the latter half of calendar 2023. I do think the deal sizes will be a bit smaller than they were in the last 12 months, but certainly see activity coming. In particular, the private equity firms have a lot of cash on the sidelines. Corporate balance sheets are really strong, so I do expect a pretty strong resurrection of activity in the deal market later in the year.
Do these would-be deal makers, Paul, just need the Fed to stop raising rates before they go out there and make a big deal?
Well, I certainly think that debt markets aren't working well at the moment, so that's very problematic. I think there's an expectation as rates start to moderate, which could happen in the middle of this year, that there will be access to the debt markets again, and that'll help facilitate more deal making.
You all just came out with a new survey of what predictions for what you think deals are going to be like this year. And even though you said we are going to see expansion, I believe it said it was only, 4% or something like that? It's not a huge expansion. Given how depressed things were, I was kind of surprised by that.
Yeah, I think there's a lot of uncertainty about that, like there's a lot of uncertainty about many things right now. So I could see upside to that. In particular, our previous survey from late last year said that 56% of CEOs were wanting to do significant M&A to transform their organizations. And the other thing that gives me some confidence, again, is all the cash on the sidelines waiting to be invested in technology, innovation, the transition to lower carbon energy sources. So I'm pretty optimistic when it comes to the deal market looking much stronger later in the year.
Are companies, if they're not going to make a big deal, are they on the verge of restructuring their operations beyond just laying off thousands of people?
No, there's no doubt that companies are trying to improve their performance in many ways. Automation is a big piece of that. Trying to spend on technology that'll help advance the work they're doing and make their operating models more efficient. That is absolutely on the radar screens of business leaders right now.
What do your clients want from you right now? Where are they most looking for guidance at a time where, as you said, there is a lot of uncertainty?
Well, they're certainly looking for guidance in areas such as emerging technology. It's been one of the big themes here at Davos this week. Artificial intelligence, cyber, really prominent discussions. But generally speaking, when it comes to digitally transforming or enabling their business models or their operating models, the spending that we're seeing in that space is continuing in a really big way. In our company, typically in a down cycle, you'd see companies tapping the brakes more on technology spending. We have seen some of that to some degree, but at KPMG, we are seeing our clients continue on their transformation journeys. I would say, generally speaking, our consulting business is pretty red hot at the moment.
One of the themes that we've been talking a lot about is noticing the tipping point for AI, what feels like the tipping point for AI. And I wonder if you're seeing that in a real concrete way in your business, or if your clients are concerned that maybe it's too early still to invest as heavily in that area.
Well, I think the two things that come to mind are what are the applications of AI and how are the business users going to come to fruition? And what will it disrupt? Because there's no doubt that AI is going to disrupt. We've heard a lot about ChatGPT this week, and there's other forms of AI that will disrupt various sectors of business. But the thing that's maybe been most prominent this week is what are the data security measures? What are the protections? Quantum safe encryption, the ability to make sure that the kinds of protective measures against cyber crime are in place to make sure that we don't become, as an American business community or a world business community, susceptible to cyber criminals.
Paul, on the topic of a disruption, there's disruption now in your industry. One of your competitors, EY, is splitting out. Now, we talked to their CEO, Carmine DeCibio, earlier on. He made a strong case for splitting up the company. Is that something you're looking at?
So we look at our business model and our strategy all the time, and we have looked at our current business model, and we are absolutely committed to the model we have today, multidisciplinary model, advisory, audit, tax under one roof. We absolutely believe that model has proven to be very resilient to economic cycles. Most importantly, it is absolutely the best model for attracting and retaining talent. We see that with our own evidence in our own organization, and we think it's great for audit quality. So we are absolutely committed to the model we have today.
Is it a philosophical difference?
I think it's a question of strategy. It's a business model question. They have different challenges than we do when it comes to certain of their clients and what they want to do and where they want to play. That particular issue we do not have. So I think it comes down to a strategy or a business model question.
What's happened during past recessions to the consulting business? What do you tend to see?
Well, in past recessions, you definitely see more clients hitting the brakes in a significant way on technology spending. Generally speaking, we're not seeing that. There definitely has been some news that technology spending is down, but when it comes to the clients that we're dealing with, the significant large organizations, federal and state governments, we're seeing the continued acceleration of the digital transformation work that we've been observing the last 3 years.
So where are the cutbacks going to come then, if not in digital?
Well,
if they have to pull back somewhere, if things are slowing down.
So part of the story is that digital is seen as a way to make business more efficient. And so the journey that these companies are on, and then state and local governments are on, and federal government, is one to make their operations both more effective and efficient. So I think there's been a recognition, particularly coming out of the pandemic, that to some degree we've all underinvested in technology. Now I think there's a bit of a premium in thinking about investing in technology to make sure that we're enabled for the future the way we need to be able to compete effectively.
KPMG CEO Paul Knopp, always nice to see you. We'll talk to you soon.
Great seeing both of you.
Appreciate
Thanks,
it.
Paul.
All right, Jared, back to you.
All right, coming up, Jan Rogers will share his top 10 predictions for retail in 2023 with a few surprises on the other side of this break. U.S. retail sales fell more than expected in December as high inflation and rising borrowing costs weighed on consumers. But our next guest still feels somewhat optimistic about the industry in 2023, confident that big box stores like Walmart and Costco could weather a recession or slow down. Now, for more, let's bring in Jan Rogers, Kiffin Worldwide Enterprises CEO, Jan Rogers. Jan, it's always great to see you here. Let me start out with the numbers today, what they mean in the context of this economy. Negative 1.1% for December. That's following negative 1% in November. The holiday season maybe not quite what it was cracked up to be with all the discounting.
Well, the holiday season was okay. The holiday season looked more like a normal year than it did in 2021 or 2020, because it looks more like 2019, where you have normal discounting. You see some pressure on gross margins because the consumer's being a little more particular. Last year, you could put anything in front of them at any price and they would buy it because they were definitely convinced that it wouldn't be there if they didn't buy it, and they wouldn't have what they wanted under the Christmas tree. This year was more normal. So, you know, the retail sales were up 6% year over year, and any other year in history, we would have thought that was fabulous. But given the inflation rate, we don't think it's fabulous. We think it's just okay. But inflation in discretionary retail didn't run anything close to 6%. So it's okay if you're a retailer that I deal with. It's not great like it was in 2021.
Looking at some of the areas month over month that we did see the biggest declines, and some of them should probably come as no surprise. Gasoline stations going down by about 4.6% month over month. But then you look at some of the other categories where you saw a massive decline in department stores. And so how does this kind of tell a different story among retail, even where at some parts of retail that are more grocery based and of course more necessity based versus discretionary, they might see even more of those consumer dollars continue and perhaps even be able to capitalize off of some rotation of those dollars out of department stores?
Well, it just depends on who you're selling to and where your life lives, right? Because if you're a department store, you're selling to the upper 60% of the economy. And if you're a grocery store, you're selling to everybody. And so we have certainly seen compression in the bottom two quintiles of the economy. They've had less money to spend on stuff other than gas and groceries, but they're getting some relief on gas right now. So in general, grocery stores inflation probably ran 12% last year. So it depends on where you were in the economy. But if you just look at it across the board, it was very tough if you're in home goods because people weren't trading homes and they weren't buying home goods because they'd been buying home goods for 3 years. They weren't buying electronics. That was tough. But apparel was actually turned out to be pretty good. Accessories turned out to be pretty good. That space, jewelry, things like that, shoes, were things people wanted to buy to go and do things and go out and travel. And travel was really great, of course. So it just depends on what the consumer wanted to do. Where in 2021, all they really had to do, and in 2020, was to buy stuff. Now they can go and do things and they can travel, and they couldn't do that before. So the money's moving that way, and then they're getting pinched a little bit by inflation. But all in all, the consumer's pretty healthy. When unemployment's below 4% and JOLTS, the jobs available, are above 10 million, most consumers believe they're going to have a job. Even if they do get laid off, they believe they can get another job, and they believe they can get a job making just as much or more than they were already. And we're seeing wages still rise in the 5% plus kind of range. So right now, the consumer looks fine for 2023. That doesn't mean it's going to be a great year like it was in 2021, where there were no markdowns and everybody needed everything and they had plenty of money to buy it with. It's going to go back to looking like it always did. If you've got the right stuff and you can offer it at the right price and you can keep your expenses under control, you'll be a good retailer. If you can't, then the consumer's going to get over on you and they're going to say, I'm not going to buy that unless you mark it down 50% instead of the 30% we want to mark it down. So I think 2023 is very likely to be the first normal year unless we do have a hard landing or unless we have some exogenous event that we're not expecting. Yes. So it's going back to real retailing where the winners will be people like Walmart and Costco, like you just mentioned, or it'll be people who are in the right place at the right time because Western wear is going to really be big. So Boot Barn can do well, Levi's can do well, Wrangler or contour who
Well,
owns
I want to
regulars
get
can
to
do well.
I want to get to some of your 2023 predictions here. One of the themes running through your notes here is the importance of brick and mortar. It's not going away. The rise of digital continuing to rise, but you're writing some specific things, and especially notwithstanding the fact that Amazon is so much retrenched from this space.
Well, Amazon really is getting out-positioned at the moment by people like Walmart, who are doing all the things Amazon does and have 5,000 stores to do it out of. Amazon's retrenching on stores. They're basically getting out of the brick and mortar business, and they're going to go back and play only in the online space for all practical purposes. And they're going to live off of AWS and other components of their business besides just retail selling, where all of the major retailers, well, even the minor retailers, have all learned that they're going to sell online, they're going to sell at the curb, and they're going to sell in the store. So as long as that's true, they're starting to regain some market share. But the market share is not going to the brick and mortar stores. It's actually going marginally online every year. Even last year, where we should have had a huge recovery in 2022 in the stores, online still gained a little bit, and it's going to gain more percentage-wise in 2023 as things normalize. So online's still winning, but stores still do, 78% of the business. And they're going forward for a while. And if you can run the store so that you can be very efficient and you can use it as a distribution center because everyone is turning their stores into distribution centers, then you can be much more efficient and you can be closer to the customer. You can reduce your last mile delivery costs and you can compete with Amazon. And for 20 years, people had a really hard time competing with Amazon because Amazon didn't try to make money in that side of their business. They just tried to drive volume. And they were a very, very difficult competitor.
Yeah.
Today, we can compete with Amazon.
Jen, one of your other top predictions, just while we have you, and we only got about 30 seconds here, I've been tracking and trying to keep tabs on what the new hype beast is of yesterday, today, tomorrow perhaps. But you think that Western wear is going to take over the world. Break that down for us.
It's going to briefly take over the world. Why is it going to take over the world? It's courtesy of Paramount. Paramount Plus basically came out with Yellowstone and 1883, which was the spinoff, the prequel to Yellowstone, and 1923, which is another prequel to Yellowstone. And they're the most popular things on television. So people who would never wear Western wear are wearing it. People like me who have always worn it are wearing more of it. And even fashion videos and things are featuring Western wear. And this really started about 10 months ago, maybe a year ago, and it should last about 3 years. So that's really good if you happen to be Boot Barn or Levi's or Contour that I mentioned a while ago, or Tractor Supply that sells lots of Carhartt, because it's not just Western, it's also outdoor looks. And we're seeing that take over. And if you haven't been invited to a Denim and Diamonds party, you will be. And you'll have to wear boots and Western look. And that's just where we're going right now. Everybody wants to be Beth Dutton. Everybody wants to meet Beth Dutton in a bar, and everybody wants John Dutton to be their dad. And that's going to cause Western wear to be great.
All right, Jen, I'll look out for my invite coming from you. Jen Rogers-Kniffen, J. Rogers-Kniffen, Worldwide Enterprises CEO. Thanks for taking the time today.
Thank you.
Definitely. Guys, coming up, United Airlines is flying high on the back of its earnings report. We're going to discuss that. Plus, we've got the opening bell on Wall Street that's coming up just minutes away. Microsoft plans to cut 10,000 employees, about 5% of its workforce this year, as the entire tech industry deals with a continued slowdown. Yahoo Finance's Dan Halley is here with the latest. Dan, what do we know about the decision? What's the impact here for Microsoft?
That's right, Brad. These 10,000 jobs make up about 4.5% of Microsoft's 221,000 strong workforce. They're said to be taking an impairment charge of $1.2 billion in the second quarter of their 2023 fiscal year. These layoffs will be completed by the end of Q3 2023. Their Q3 ends the end of March 31st, so it doesn't line up with the actual calendar. It's their fiscal calendar, but they're saying it'll represent a 12-cent negative impact to their diluted earnings. And this comes as Microsoft, as well as the broader PC market, sees a significant slowdown compared to during the pandemic. They're seeing shares down 22% year over year. PC shipments declined 28.5%. And they've also seen slowdown in the cloud market. They're still growing, but growth in Q1 of 2021 was at 31%. Growth at Q1 in 2022 was at just 20%. So they're still seeing that growth, but you're starting to see it slow down over time. And as I said, that PC market also really struggling as a result of the pandemic. Once they get through that kind of comparison, though, they could see some improvements as far as sales go. But, one of the experts that I had spoken to at Gartner Research had said it could be several quarters before we start to see any kind of real return to growth for the PC market. So that spells trouble, obviously, for both Microsoft as well as chip makers like Intel, AMD, and NVIDIA.
All right. Yahoo Finance's own Dan Halley. Dan, thanks for breaking this down further for us. We'll keep a close eye on shares of MSFT as we're just seconds away from the opening bell on Wall Street. And Jared, we got some of that economic data out this morning that certainly kind of shifted the tenor going into the start of today's trading activity as well.
A little bit of bad news and a little bit of less bad news. So the PPI number was less bad, not as bad as feared, and that kind of ties into the lower inflation, the lower CPI reading that we got, I believe it was last week. But then the retail sales, just a disappointment. Lots of expectations about the retail sales over the quarter, but not a go.
Yeah, we're taking a look at the opening bell on Wall Street. All right, that begins today's trading session here on this Wednesday. Happy Hump Day to all of you who celebrate. Taking a look at Vitesse, ticker symbol VTS, ringing the opening bell over at the NYSE on Wall Street. And keeping a close eye on the major averages as we get into the start of today's trading activity. We had seen the futures really move to the upside there, and looking like out of the gate, we are still up across the board there. The Dow up, S&P 500 and the Nasdaq all seeing green right now, Jared.
That's right. And you take a look at the Nasdaq, it's been up, it will be, if it closes in the green today, it'll be up 8 days straight. The Dow just snapped a 4-day winning streak yesterday. And what I want to point out is this is the opposite of those rallies that we saw late last year. Well, I guess in the second half of last year, because those were led by the Dow, whereas tech was lagging. So kind of a reversal of fortune here. Sometimes when things are different, you got to pay attention. So here's the Nasdaq Composite over the last year, and you can see still hasn't exceeded its highs from December. So a lot of work to go right there. And the Dow similarly situated, but a little bit higher up in its chart there. So let's take a look at the sector action for today. Consumer discretionary in the lead. That has been the story of the year. After being the worst sector last year, or one of the worst, it has been the top one this year. And we got lots of retail news today, including a Party City bankruptcy. Materials also in the lead, along with energy, tech, communication services, retail, real estate, rounding up the top row. So pretty nice broad breadth of outperformance, financials and staples. Financials, we can get to some those earnings in a little bit, but that has been really the story of the earnings week.
Yeah, absolutely. And with that retail sales data that you mentioned a moment ago and right before the bell, it was interesting to see some of the retailers that we had pulled up earlier too. The biggest declines month over month in department stores, furniture stores, that was down 2.5%, outpacing some of the declines that we'd seen month over month in the report wholesomely. And then additionally, electronics, that continued to move lower as well. So we'll keep an eye on some of those retail names. But speaking of retail, you also mentioned Party City. And this one is a major announcement that came today. The party has to come to an end as Party City has officially filed for Chapter 11 bankruptcy. CEO Brad Weston says that today's action is taken to strengthen PCHI's, that's Party City Holdings, balance sheet, and is going to bolster the ability to further advance strategic priorities and continue to innovate and elevate the customer experience here. Now, some of the issues had shown up ahead of time within the most recent quarterly earnings report that came out from Party City. We had talked about this before when this was even something that the company had to weigh, and they had talked about the expectations and the macro pressures impacting customers' abilities and willingness to increase spend on Halloween celebrations last year. They had seen people purchasing less balloons on the wholesale side as well. And so less balloon purchases, less of the Halloween purchasing. And then additionally, within this statement announcing their bankruptcy proceedings that they're going to go forward with, they're actually going to continue moving forward as debtors in possession. That just allows them to continue on kind of paying out some of and kind of operating on an as normal basis, if you will, to really cover some of their costs in order to emerge on the other side of this, hopefully from bankruptcy.
Brad, you've been to a Party City recently?
Yeah.
It's kind of like a dollar store, right?
It is.
In a lot of ways. So I think the lesson over the pandemic was if you don't have a digital strategy and you're something like Ross Stores or TJX, you better be really solid in your execution, because in this changing macro environment, with all the inflation and the vicissitudes, not only going up, but also on the downside, you got to be able to manage not only your costs that you're selling to consumers and also your input costs, but also your wages. And that's been the sticky point, and I don't think those are going away anytime soon, hence the stickiness of wages, Brad.
Yeah, you're taking a look at, of course, that's the max chart for Party City where it's
a penny stock.
Yeah.
So and not you might expect this.
They had already received actually a delisting notice as well, and so this just adds to that, and we will see exactly how the company positions itself to try and emerge from bankruptcy on the other side of this filing here. Also here, we got to talk about shares of UAL, United Airlines. They beat expectations on earnings on both the top and bottom lines. Earnings and revenue beat there for the fourth quarter. It was up 14% compared to 2019 as the demand for travel, that continues to grow. This has been something that we've kind of heard as a common denominator across some of the airline operators. We heard that within Delta. Even Hilton CEO during our All Market Summit called it the golden age of travel that we're entering into here. And it really begs the question of where that travel demand is coming in from. Of course, you've got more of the leisure travelers out there, more business and leisure, where you've got people that are saying, you know what, if I can work from anywhere, I'll do just that, and I'll hop on a flight to get there, and perhaps I'll spend a little bit more in order to really accommodate myself, and especially if your business is covering part of that. But I think within this report, there was also a little bit of Southwest shade that they threw.
Oh, I saw that.
Yeah,
it's like we got our house in order.
Yes.
No need to wait in those long lines and reschedule flights for days on end there. I'm looking at the Wi-Fi Interactive. I have our travel and reopening heat map up with a year-to-date look that's showing a lot of green here. You take a look at United, that's UAL, I'm circling it in red right there. That's up 38%. Now, you take a look at what's happened over the last year, it's a different picture. And of course, we've got a lot of ground to reclaim, except for Trip.com at the top. That's an outlier there. But really, things started coming back, about 3 months ago? And we find that some of these numbers here, UAL up about 39%. Well, that's almost all of that coming in the current year. So maybe a new year for travel here. I do like what Deutsche Bank came out. They said, and by the way, they rate the stock a buy with a price target of 60. They said United comes out swinging with strong results in 2023 outlook. Their December quarter EPS much better than expected, while the beat was mainly down to strong revenue growth. You look at some of their key metrics like seat miles, that was a beat. Just overall, you get the sense that travel, we might finally have a almost normal year for travel, Brad.
Yeah, and it's really interesting, especially what they're citing. And of course, the company is going to give a little bit more detail on this report at around 10:30 a.m. Eastern time. Their call doesn't happen until this morning, as opposed to typically taking place after the call or after the earnings release drops that night. And so with that in mind, we're going to be staying tuned to see if any more details emerge from that call this morning during that 10 a.m. Eastern time hour. But even when you look across the seat miles that are available, let's remember that the broader airline industry is still trying to come back to full capacity.
Yes.
So United included, American Airlines included, Delta Airlines included in that, and Southwest, I don't think they're going to be able to get back to full capacity based on their words until sometime in 2024, perhaps late 2023 at best. But with all of this in mind, it's going to come back to how they're able to operate the existing percentage of the flights that they've got in order now too.
Yep, Moderna up 13.5%. No real big segue right there, but big news coming in the healthcare market. And that's after Moderna announced a successful third round of testing for its RSV lung disease vaccine. And for more on this, we're going to bring in Yahoo Finance's Anjali Khemlani. And let me ask you, what's the latest on this?
Well, Jared, we got the top line view of the phase 3 clinical trial for that RSV for older adults vaccine from Moderna. The numbers look good, 83.7% effective against the milder version with 2 or more symptoms, and 82.4% effective against 3 or more symptoms. And the company has already said that they plan to file in the first half of the year. Do recall they do have basically an expedited voucher for review from what they did with COVID, so that could come in play here. Compare that to what Pfizer let us know back in August for their older adult vaccine, which is 66.7% effective against 2 or more symptoms and 85.7% effective against 3 or more symptoms. So a little bit of a difference if you compare the two. There are some analysts out there saying Moderna could have a good share of the market. Pfizer a little bit ahead in the maternity vaccine. They've already given us top line results, while Moderna is starting a pediatric trial, phase 1 right there. So a lot going on in the RSV space. It seems to be the new spot where these two are going to be competing, so keep watch.
Andrew, we got to leave it there so we can get back to Davos. Coming up, we're going to head out to Davos for some of the key takeaways from the day on the other side of this break.
Talking about recessions. But of course, when I talk to people and ask them about their business, they seem to think their business is okay. So everyone here seems to think the other person has a problem.
Mild recession, slightly down for a couple of quarters and then back to slightly up and then more normal in 24 and into 25.
I don't think that we are too deep into recession so far.
I think there will be parts of the world that go into recession this year, but we will choose to ignore that in the parts of the world that are enjoying continued growth.
Recession is a word heard around the Alps and Davos, and those were just some of the voices we've heard from so far, warning that a recession could be coming this year. Now let's get back on the ground in Davos, Switzerland, where Julie Hyman and Brian Sazi are standing by. You guys look great, if not a little frigid, but how are things there?
Well, not bad, Jared. No, we're not frigid. So it's a little cool out here, but all things are going well. Maybe actually a lot better than what we're hearing from executives here in terms of how their businesses are going and the economy. A lot of executives, like we just talked to, you saw on the tape right there, focused on recession, planning for recession in some cases. We just talked to KPMG, U.S. CEO, looking at a lot of companies potentially looking to restructure their business.
Yeah, and sort of preparing for a slowdown is what we're hearing. But it's not that negative, really, the rhetoric that we're hearing, despite what you just heard. Yes, people are talking about a slowdown. They're talking about a potential recession. But we also heard, less pessimistic comments from IMF head Gita Gopinath, right, where she was talking about, the economists there are talking about that we're going to have a slowdown, but it maybe won't be as bad as first feared. And the other thing that struck me that I thought was really interesting, Brian, we talked to Chuck Robbins of Cisco, and he said, all you guys in the media want to ask us about recession, and people externally want to talk about recession, but the meetings he's having with other executives, the meetings he's having with global leaders, they're not necessarily talking about recession. They're talking about specific business initiatives, specific partnerships, specific philanthropic work that they are working on. So it's interesting, that sort of divide, if you will, between the discussions we're having and we want to know about and what they're discussing amongst themselves.
Right, Julie, and that's one bubble here. And the other bubble is just this overall event. You're hearing news and you have investors on the Yahoo Finance platform right now seeing or waking to news of Microsoft laying off 10,000 people. I look down the promenade, I see Salesforce recently laid off almost 10,000 people of its, that's Amazon, 10,000 people. They have an installation here, 20,000 layoffs alone from the two big tech companies on this promenade here at the World Economic Forum. And on Thursday, Microsoft is slated and reportedly to have their cocktail party, guest singer Sting. Now, I would have liked to see more humility here from these big cocktail companies, because in many respects, they are acting the same way they did at every other single World Economic Forum I've been here, and unlikely the ones that I wasn't able to get to because I wasn't in this field.
I know. We'll debate more on that later.
Okay. Well, continuing the conversation, though, you also heard some criticism on tech from friend of the show, Ian Bremmer, while you were out there. What did he have to say?
Well, Ian Bremmer of Eurasia just talked about the dominance of tech titans and their disinterest in being really stewards of democracy and playing that role. This is what he said.
That's Elon Musk, that's Jeff Bezos, that's Mark Zuckerberg, it's all these people. But the fact is that those people worth hundreds of billions of dollars also, at the same time, have literally no interest or conception in their role as stewards for civil society and American democracy. That is the different sides of the absolute same coin. And all of America's lionizing free markets and capitalism has also led to a vastly more dysfunctional democratic process, because these companies are inadvertently, but nonetheless, aligning with business models that destroy democracy.
And he was talking about, in particular, social media. He brought up the idea that China does not allow many of these social media platforms there because they see their destructive power. So that was an interesting theme that he was talking about as well. Not as much of the zeitgeist here, but still an interesting point that he made. And we're going to hear much more of Bremmer's comments later in the show.
And Ian was very much right on the mark. And by and large, big cap tech has been unchecked by various administrations and the government for some time now. And guess what? Newsflash to these folks in government: the next wave of AI and AI intelligence is coming. And we've talked to a lot of executives here that this could be a job killer. We've got to sample some apps here and what they could and may or may not do, and they're absolutely mind-blowing. One of my thoughts among many is, well, wow, that's going to be, we're going to need probably fewer workers at XYZ company.
I want to circle back to something you were talking about before, just real quick, which, all these layoffs that we're talking about and the disconnect between that and the obvious spending that's happening here. Optically, yes, but from a real perspective, if you look at how much they might be spending here on the promenade and really realistically how many jobs that's equal to, we're not talking about a lot, but it's an optics issue rather than a real, like, how are they allocating the spending issue. We also know they're not cutting jobs across the board. They're cutting them in areas where they overhired or that they don't think are going to grow as much.
You're right on the mark, Julie. Optically, it's not a good look, because if you're a Microsoft employee today that is getting a pink slip, you're probably going onto LinkedIn and posting and letting your network know about that you are no longer employed by Microsoft. Then you might also see news that, oh yeah, Sting is playing at a Microsoft cocktail party at one of the most exclusive events for CEOs and billionaires in the world. I think it's an extremely big disconnect, and I'm very fired up about it, clearly.
Clearly.
Well, it's hard to
Back to you
imagine
guys.
It's hard to imagine that anybody would throw a tomato at Sting while he's performing, but I would point you in the direction of Ian Bremmer if you do see a tomato thrown. Thank you so much for checking in with us here, Julie and Brian. We'll check back in later on. Coming up, we're actually going to stay in Davos for Julian Sazi's interview with Nouriel Roubini. You do not want to miss it.
Dr. Doom is how he's known, although at our All Market Summit last fall, he told us he prefers Dr. Realist. I'm talking, of course, of NYU professor and economist Nouriel Roubini. We talked to him today about some of the themes being discussed here at Davos, what has been dubbed the poly crisis going on right now, all of the things in the world going wrong, climate crisis, the Russian invasion of Ukraine, etc. His book is called Mega Threats, which is basically a different word for the same thing. Listen now to our conversation with Nouriel Roubini.
I've been speaking about mega threats, not just economic, monetary, financial, also political, geopolitical, environmental, health, technological, deglobalization. And now this buzzword of polycrisis, the same idea as mega threat, is one that everybody's using. You know, I was on the stage with the head of the IMF last month in Washington, and she spoke about the confluence of calamities, saying that the world economy has never faced so much threat since World War II. Larry Summers made the same kind of arguments. And the WEF just published their world global crisis report, in which is talking about severe threats and about polycrisis, and there are all these interconnected threats that are both on the economic side, political, geopolitical, social, environmental, health, technological, and so on. So I think it's becoming something of a common wisdom. And the topic of the WEF this year is cooperation in a fragmented world. The emphasis on the fragmented, because there is not much cooperation in a world in which there are geopolitical depression and great powers are rival with each other on most things. So it's a world of mega threats or polycrisis. And doesn't matter how you call it.
It's all disturbing.
Is this the same idea?
Large part because of that fragmentation, Nouriel, there's a lot of CEOs here predicting a mild recession. Do you think they will be surprised by the severity of any recession we do get, if we do get one?
Yes, the consensus is about the short and shallow recession, a couple of quarters negative growth, and then you have a collapse of price and wage inflation. The Fed, ECB, and others stop hiking by mid-year, then they cut rates by the second half, and then markets and economy grow again. I'm skeptical for many reasons. Reason number one is that there will be a spike in commodity prices this year, not just energy, but also all across the board, other ones. Goldman Sachs actually predicts a 42% increase in commodity prices this year. And the reason is there has been a massive underinvestment in new capacity, not only in oil and natural gas, but across the board. Demand is growing gradually. With China coming back to growth, there will be more demand, supply is constrained, you'll have a spike. Second reason is that labor markets all over advanced economies are very tight. Unemployment rate is very low. Labor force participation rate has fallen, aging of populations, restriction to migrations, the great resignation, labor strife, fiscal policy are pro-labor. So you don't need more than 5-6% wage growth like in the US, with productivity 1% to have unit labor costs going up 5%, and therefore inflation getting stuck around 5. It's easy to go from 10 to 5, it's much harder to go from 5 to 2. And in the service sector is dominating the economy is mostly labor costs rather than raw material and so on. So my view, markets and Fed, ECB will be surprised on the upside on how much, while inflation has fallen now, is going to remain sticky around 5-6%. And then they'll have a very tough dilemma. Either they raise rates more, say towards 6% for the Fed, about 4% for the ECB, and they cause a real hard landing. And on the top of the hard landing, there is also a financial crash, stock market, credit spreads, bond yields, and so on. So you have economic financial crash, so a real hard landing. They feed on each other. As you have more distress, you'll have more of a recession, and more recession means more distress on the debt side. Or, as I believe they're going to wimp out, they're going to blink, they're not going to raise enough. But then you have a de-anchoring of inflation expectation. You get a wage price spiral, and then you end up again with stagflation, and you postpone that crisis by a couple of years. So damn if you do and damn if you don't. I think the optimism is really misplaced.
Well, do you think the Fed would be to blame here? They're unwinding this massive liquidity here, raising rates. They have raised rates aggressively. The U.S. housing market is slowing down. Aren't they the ones to blame for a potential massive recession in the U.S.?
Well, inflation got out of control, in part because there was loose monetary, credit, and fiscal policy. So the Fed has to be blamed, like other central banks, for not seeing the rise of inflation. Secondly, there were also negative supply shocks that reduced growth and increased inflation, like the impact of COVID on production, on global supply chains, on labor supply, the impact of Russia-Ukraine on global commodity prices, and of course, until recently, the zero-COVID policy of China. So it's a combination of bad policy and bad luck. Now they have to make up for it, but the problem is that if they raise rates enough, they cause an economic and financial crash. And in my view, we are in a debt trap. There is so much private and public debt in the world, rising from 100% of GDP to 420 in advanced economies since the 70s, that you cause not only an economic crash, but also a financial crash that feed on each other. Therefore, they have to wimp out, and therefore we're going to live in a world of much higher inflation, around 5-6 as opposed to 2. That's where we're going.
Let's talk a little bit more about that potential financial crash. We talked to you back in the fall at our All Market Summit, and you talked about some of the same themes.
Yeah.
Now here we are in the new year, and most of the strategists, at least in the United States, are looking for a little bit of a gain in markets this year. It doesn't, from what you're describing, that doesn't sound like that's a scenario that you would be predicting. How bad is it going to be this year in equity markets?
Well, if you believe in the softish landing scenario of a short and shallow recession with a couple of quarters of negative growth, say Q1 and Q2, then the market is a bit wobbly, but by the time that there is a slack in goods and labor market because of that recession, you have a drop in price and wage inflation, then the Fed doesn't go all the way to 5.25, stays around 4.75, and then they cut rates already in the second half of the year, and then you have happy endings for growth and for the markets in the second half of the year. That's assuming that actually the markets are right. First of all, the Fed is telling the markets, no way, even if we're optimistic, inflation is going to be slightly higher than you expect. We're not going to have a real recession. We'll have a soft landing. Therefore, we have to go all the way to 5.25, stay on hold until the end of the year, and then cut rates next year. So there's already a massive disconnect between markets and the Fed. And the markets being ahead of the curve makes the problem of the Fed worse, because the easing of financial conditions, with stock market going higher, bond yields falling, the dollar weakening, credit spread narrowing, implies more growth, and it makes harder for the Fed to achieve their inflation, and they have to tighten actually more, given this tug of war between markets and the Fed. What I'm saying is that both the Fed and the market will be surprised on how sticky inflation is going to be once it gets around 5-6-ish, and then either they do much more, causing economic and financial crash, and in which case the equity market is going to be really sharply down, because in a severe hard landing from current level, equity prices will have to fall another 20%, or they wimp out. If they wimp out, then the market is going to rally. There'll be a Powell put for a little while, but then once you have a hinging of inflation expectation, long rates rise, and then you still get down the line a crash of the stock market. You just postpone it by 6 months.
Two bad choices for the Federal Reserve and the markets in a backdrop of 5 to 6% inflation. Noel Rubini, as always, delivers when it comes to perhaps not a terribly sunny outlook. We'll be back with more from Davos a bit later. More Yahoo Finance coming your way next.
Welcome back. Layoffs have rippled across Wall Street, with banks, including Goldman Sachs and Morgan Stanley, announcing job cuts. But taking a closer look, the picture is actually mixed when it comes to the scale of these cuts for the big banks. Alexandra Semenova has that story for us. Alex.
Well, guys, we've been hearing a lot about finance layoffs lately, and they certainly are happening. You know, Goldman Sachs laid off more than 3,000 workers last week. There were even reports that bankers there were calling it David's Demolition Day after CEO David Solomon. But taking a more nuanced look at what's going on, the layoffs actually at this point aren't as widespread as it seems. Yesterday, Goldman Sachs and Morgan Stanley reported their earnings and also confirmed that they laid off thousands of workers in the past 2 months. Goldman Sachs about 6% of its workforce, and Morgan Stanley about 2%. Then we've also got Wells Fargo that has been steadily cutting jobs as it scales back its mortgage business. But top executives at JP Morgan, Bank of America, Citigroup have all said that they have no immediate plans to cut jobs, even in the case of a recession. Bank of America's Brian Moynihan told our own Brian Sozzi yesterday that there are no plans to cut jobs. You have all of these executives on their earnings call saying that they're still in hiring mode. JP Morgan CEO Jamie Dimon said that they'll continue to hire jobs. They have no plans to cut them, even in the event of an economic downturn, which differs a lot from what executives like David Solomon and James Gorman have said. For Goldman Sachs, for example, though, its investment banking division makes up more than 50% of its revenue. So because we've seen that sector take such a big hit in the past year, it makes sense that it's being more conservative and cutting jobs where it needs to. And then for Morgan Stanley, it's cutting about 2% of jobs, which is, it's a natural culling that is happening. During the pandemic, we saw a pause in these performance reviews that banks normally have in the annual culling that typically happens, but they're bringing that back. It's pretty normal for these banks to let go of bankers who are underperforming at the end of the year. So, when it comes to finance layoffs, they're not as widespread as what we're seeing in the technology sector, for example, where it's happening across the board, where there are thousands of workers. Seemingly every day we're hearing announcements from companies. In the financial sector, it's a little bit different.
Yeah, and within those banks and the segments that they report for, it's been interesting to see where some of those disclosed layoffs have taken place, or on the other side, where they've started to cut some of those bonuses as well in the interim period of time too, given some of the underperformance year over year.
Exactly, Brad. Bonuses will be an interesting one too, because the anxieties over layoffs now shift to bonuses. And any workers who didn't get laid off will probably wish that they did when they see those really lean numbers come in the coming weeks. And that's kind of what banks are hoping for. They're hoping for that natural attrition to happen. So anyone they didn't lay off, any performers that haven't been, up to par, will see their bonuses come in at near zero levels or substantially down from last year, and maybe go out and look for another job. And that will lean out those workforces even more. And it's going to be interesting to see what happens when it comes to the different divisions within banks, because their performance has varied so much. Because the trading desks, as we saw in yesterday's earnings, have done very, very well. But then you have the investment banking side at all of the banks, which is down, more than 50% from last year. So it'll be a mixed picture too when it comes to the bonuses.
Yahoo Finance's own Alexandra Semenova breaking down all things financials and big banks for us today. Thanks so much.
Thanks, guys.
Guys, coming up, we've got more from Davos, including an interview with Carlyle Group co-founder David Rubenstein. You do not want to miss it.
Way we get around here so we don't walk and risk sliding. It's not bad. Pretty good way.
Welcome back to Yahoo Finance Live. I'm Jared Blickery alongside Brad Smith. Markets, as you can see, are in the green. The Dow up about 11 basis points. We're going to take that. And then the Nasdaq up an 8th day in a row. That is up 1%. Russell 2000 also up 1%. And the S&P 500 up about half of that, 0.5%. And let's take a look at the sector action today where we have consumer discretionary. That's XLY. That is in the lead. That's up 1.5%, the best performing sector of this year and the worst performing sector of last year. Energy also up more than 1%. So is tech, rounded out by materials and communication services on the outperformers. Following up the rear here, staples, utilities, and financials. Financials coming in. Let's take a look at the big banks here. We had PNC reporting earlier. We could see Goldman Sachs up 1%, UBS up the most here, up about almost 2%, and Bank of America in the red for about 1%. But also taking a look at some of the market leaders today. ARC, that is up 2.5%, followed by MJ, that's cannabis. Retail doing well. We talked about that. Transport, solar, chip stocks, internet stocks, and home builders. Those are all doing well today. So kind of a broad swath here. Just want to wrap up with the bond market. We do have a huge drop in the 5-year. That's down 15 basis points. And also want to show you the 10. That's down 14 basis points, Brad.
All right, Jared Blickery, thanks so much for setting up this top of the hour here and really framing this next conversation. Market conversation here is elevated volatility. It remains a sticking point for investors in this new regime. Here to discuss, we've got Candace Say, who is Goldman Sachs Asset Management Global Head of Strategic Advisory Solutions. Great to have you here with us this morning, Candace. First and foremost, as we're hearing conversations coming out of World Economic Forum and Davos around and acknowledging what a mild or a shallow recession might look like, but then also in the same breath saying, hey, we're out here to make deals and govern our business to really weather through that. How can investors glean insights from that in order to position their portfolio best?
Absolutely. Last year, 2022, a lot of investors faced alarming headlines across the board, whether it was high inflation prints, central banks raising rates, and then also you had all the geopolitical activity that was happening across the world. So all of this contributed to that extraordinary year of volatility. So as an investor, just to put into perspective what we've been through, essentially we had 219 trading days where the S&P 500 moved over 100 basis points intraday over the course of the last year. That means 85% of the trading days that we experienced last year were highly volatile between beginning to end of the market. And with that said, we think that moving forward over the course of the next decade, as we move into this next cycle, we think there's going to be more levels of volatility in our future. So the things to consider given this type of environment, we think that investors should really start thinking about left tail risk, but also really focusing in on asset classes that they traditionally haven't thought about within their portfolio construction, and also active management. Those would be 3 ways that we think investors should start thinking about their portfolios moving into a period of more elevated volatility to come.
Well, let me ask you, can you enumerate some of those alternative assets that you were talking about that are available to retail investors? Because a lot of those are only available to institutional investors.
Absolutely. There are a couple of different avenues for normal investors who have the ability to invest. For example, multi-strategy hedge funds is one way that they can access a diversified portfolio of hedge fund investments. Typically, if you're able to diversify your portfolio with multi-asset class hedge funds, you can actually increase your potential for return, especially as you compare it versus the S&P 500, especially in times of volatility. The other area within alternatives I would talk about is private assets. So if you're looking to maintain a long-term strategic allocation and portfolio construction, this is a way that can enable you to stay focused on investing in the long term because you do have capital locked up for anywhere from 10 to 15 years. So again, that really depends on the wherewithal for clients, depending on where they are in terms of their investment acumen and sophistication. But there are ways to access multi-strategy hedge funds, but also private credit, private equity, if they have the ability to.
What would you be looking for kind of a concerted turn in the markets here? And of course, we had seen the rally of the past couple days here, but then you think about going further out into 2023 and getting past this first quarter and the ripping off of the Band-Aid as we continue to talk about that many businesses are doing right now just to set expectations. When is that concerted, that turn from your calculus and your estimation?
Absolutely. We all know that the equity markets in particular is a forward-looking mechanism and machine, and it tends to move before economic data is in place. So with that said, with many firms calling for a recession, our firm being one that is on the lower side of the probability, we still believe that there is an opportunity for a potential soft landing, the potential to avoid a recession. But nonetheless, it's going to be a tough year. Given our base case of no recession, if that is the correct call, we do believe that markets probably stay around the level it is today, around the levels of 4,000. But as you know, forecasting is more of an art than a science. So in thinking about what that means to have a 4,000 level on the S&P 500, that would mean earnings of about 0%, so earnings growth, and the earnings level of 224, which is exactly what we ended last year, 2022 at. That's our base case.
All right, we got to leave it there, but really appreciate your insights here. As always, Candace Say, Goldman Sachs Asset Management Global Head of Strategic Advisory Solutions. Now, turning to the crypto space, Bitcoin off to a promising start this year as it seems to be shaking off the negativity from 2022. Bitcoin maintaining its winning streak, approaching its longest span of gains in nearly a decade. That's going back to almost a decade. That's going almost back to the beginning, and that's according to Bloomberg. And just looking at the Wi-Fi Interactive now, I've been saying the 20,000 level is key to hold. You can see we are at 21,000, Brad, and about a half. And let me just pull up a 3-year chart so we can see the big picture here. And I'm looking at this downtrend line. Well, that was terrible. But it has broken out from that, and it has broken above that 20,000 high. You can't see it on this chart here, but it was the high in about 2017. There we go, on an intra-month basis. So technical is kind of perking up here a little bit.
Yeah, and even as we minimize that Bitcoin chart and take a look at some of the other cryptos that are kind of moving in lockstep, or at least in concert, take a look at Ether here, because that is up by about 33% year to date. And of course, we are early in 2023. A lot of things could happen. There's been this crypto ice age, as some of our guests have called it, but I think many people would nod to the crypto washout, or at least the winter that we find ourselves in, where there's been a lot of need to really prove the project at the end of the day. And so with the wipeout in some sentiment that's taken place, whether that be on the algorithmic stablecoin debacles that had happened midway through last year, and then even further as you had the FTX wipeout here as well, and that continuing to really rattle some of the sentiment late in 2022 and then even into the early moments of 2023. Now with this most recent run, it's a question of, has that sentiment started to improve? And if so, among who? Is it the everyday buyer, or is it some of the whales that are perhaps sensing opportunity out there?
I got to tell you, Brad, I think there's only one whale that matters right now, and that is Binance. If Binance stays afloat, and I have no specific knowledge why they should not, I think we have the bottom in Bitcoin. But if we have a fall out there, there are going to be more dominoes to fall.
That's a great point.
Switching gears, IBM hit with a downgrade from Morgan Stanley. The firm shifted its rating to equal weight from overweight, as well as lowering its price target to $148. Morgan Stanley analyst warns IBM may undergo some pain from decelerating revenue growth and changes in the economic cycle. Yahoo Finance had a chance to sit down with IBM's vice chairman yesterday at the World Economic Forum, and here's what he had to say on the company's turnaround efforts. Take a listen.
I think Arvind has laid out a very distinct plan on revenue growth, on free cash flow growth, and he continues to execute upon his plan.
Coming up, the Federal Election Commission have dismissed a campaign complaint against Google. Brad with more on that, plus other top stories you need to know up next.
Welcome back. Among the top stories that we're following for you today, the International Energy Agency is lifting its 2023 forecast for oil demand growth by roughly 200,000 barrels a day, largely due to China's reopening and an expected turnaround for the economies of the U.S. and Europe. Total oil demand is expected to average nearly 102 million barrels a day. That's a record amount that's well above pre-pandemic levels. Nearly half of this year's increase in oil demand is due to the expected return of international travel. Demand for jet fuel is expected to grow by 850,000 barrels a day. The Federal Election Commission is dismissing Republican complaints that Google's Gmail app helped Democrats in last year's election by sending Republican fundraising efforts to spam at far higher rates than Democrats, amounting to unreported campaign contributions. But in a letter to Google, the FEC said it found no reason to believe Google made prohibited in-kind corporate contributions, and any skewed results due to its spam filter algorithms were unintentional. And China has cleared Disney's Marvel Studios to release 2 of its Marvel movies for screening in China, suggesting an easing of censors for Hollywood films. Black Panther, Wakanda Forever, and Ant-Man and the Wasp, Quantumania, at Chinese theaters next month. They will be the first superhero franchises to be released in China since 2019. Jared?
Apple has bombarded consumers with plans to shift its supply chain, decreasing its reliance on external producers and moving to make its chips and screens instead. For more on this, shift to design components in-house, we're going to get to Yahoo Finance's technology editor, Dan Howley. Dan, spill the details, please.
Yeah, Jared, that's right. Apple is essentially making some big changes inside and outside of its devices. And we'll start with what the announcement that they provided us with yesterday. Their 2 new chips. They have their M2 processor, and now they have their M2 Pro and their M2 Max. These are going into the MacBook Pro and Mac Mini. So this is part of the strategy that they're kind of playing out overall, where they're pulling away from these third-party partners and pushing everything in-house. Now, it's important to note that they're not building these chips. They're still using partners like TSMC, Taiwan Semiconductor, but they are designing them. So rather than relying on the likes of Intel, which they've stopped their relationship with, they're doing this on their own. And this goes beyond just the processors inside their devices, whether it's their iPhone, their iPad, or Mac. It also goes into the modems in their devices. We know that they're going to be weaning themselves off of their reliance on Qualcomm for their 5G chips. That was supposed to happen this year, but because of some technical difficulties that they ran into, they're going to continue to rely on them, at least for now. And then next year, they should be going with their own chips. And they're also reportedly trying to wean themselves off of Broadcom, which provides the Wi-Fi and Bluetooth chips in iPhones. They'll be stopping those in the near future and building their own dual chip, and then eventually a 3-piece chip with their modem, their Wi-Fi, and their Bluetooth. So what does this all mean? Well, it does mean that Apple can provide newer devices faster and under their own desires. So design is no longer going to be limited to what producers of these products mandate. Apple's going to be working on its own displays, according to a report from Bloomberg. They'll be able to then manipulate those to provide better devices. And we're seeing that now with some of their laptops and desktops, where normally with the MacBook Pro, we would see it languish for years without getting any kind of update as far as chips. Now we're seeing updates on a regular cadence because Apple is able to do this. That allows them to say that they are updating quicker, that they're more desirable than you would see from a competing Windows device. And so that can help them draw market share. And I just want to point out what their market share sits at right now. They own about 10.7% of the global market. They're still well below the likes of Dell, which is at 16.7%, HP at 20.2%, and Lenovo at 24%. So they still have a long ways to go as far as making up that market. But if they can do this, they should be able to start collecting a little bit more of that. And we also actually have Loop Ventures' Gene Munster kind of basically saying the same thing, saying that the benefits of their speed at Apple will provide them this kind of incentive for consumers for decades to come. So, this is all part of their big push, bring everything internally, and then give the benefits to consumers, that should help their bottom line.
So Dan, I'm going to bring you and I's elevator talk here to the screen for our viewers. What part of the phone that Apple doesn't yet make or does not or has not announced intentions to begin manufacturing and bringing into this vertical integration, what part of the phone don't they do that they could later seek out, perhaps bringing in-house?
Yeah, right now it's the big thing is the screen, right? So when it comes to smartphone design, a lot of it is dictated by obviously the screen because people want their screens to be bigger now, and the battery. The battery needs to be large enough to provide a charge. Apple could theoretically build a battery on its own and go ahead and help kind of use that to change the look and feel of the iPhone to what they want. And with the display, they'd be able to present a better looking iPhone overall, especially if they move to this micro LED, which is apparently what they're supposed to be doing. One report says that on the Apple Watch, it looks like the words kind of float on the glass rather than being underneath it. So it would be a significant change to the iPhone. And we've seen them try to make changes as of late. There's nothing been really groundbreaking. There's the dynamic island, which is interesting, but doesn't really do much outside of allow you to access your music from your home screen without having to go into an app or a timer. The camera's obviously always getting an upgrade. Sony generally produces the chips for that. Apple could work on those on its own and see if maybe they could change up the iPhone there. But there haven't really been, as I said, these kind of groundbreaking movements in the iPhone. If, though, they're able to do that with the display, if they're able to maybe change things with the battery, they'll be able to provide a completely different experience. But we'll have to wait and see. Don't take that to mean folding phones. That's not going to happen.
No imitation there. All right, thank you for that, Dan Howley. Coming up, we're going to head back to Davos for a conversation with Carlyle Group co-founder David Rubenstein. You won't want to miss it.
Well, as we've been talking about during our coverage here in Davos, one of the buzzwords of this World Economic Forum is polycrisis. Another, of course, is recession and the debate over whether we're going to have one. Joining us now is David Rubenstein. He is the co-chairman and co-founder of Carlyle. And of course, he is well poised to talk about this because you talk to a lot of people, you do a lot of deals, you talk to people not just as part of your job, but also as part of your job hosting and interviewing people. So you have a pretty diverse set of voices in your head, so to speak. How are you synthesizing all that? What's your feeling about what the economy is doing?
The press that has been written about Davos suggests that people here think that we're going into a recession for sure, and things are pretty gloomy. I don't really agree with that. The numbers that we have in our own companies at Carlyle don't suggest a recession is imminent. And we also think that the U.S. policy to get inflation down is probably working. And so I don't really think it's clear we're going to go into recession in the third or fourth quarter. It is clear that the Fed will increase interest rates again, probably in February and March, but not by so much so that will put us in a recession. I think the Fed will probably target inflation down to about 3%, not 2%. Their current public position is 2%. I suspect in time they'll go to 3%.
Do you think they'll be able to get it there?
I think they will by the end of 2023. I think they get it to 3.5%, yes. And I think that's tolerable. I mean, 2% is good. We had it for 25 years, but 3% is tolerable.
David, if we're not going to get a recession, is this a stagflationary environment? Still high inflation, slow growth, and what would that mean to the investing public?
Well, clearly, inflation will be bigger than it was last 25 years or so. So it's going to be lower growth than we probably had a couple years ago. But remember, an economy of our size, $23, $24 trillion, it's hard to grow at 4 and 5 and 6%. So I suspect we'll probably grow at 3.5%. And I don't know if I would call that stagflation. It's a reasonable growth for the economy of our size.
We're coming off of obviously a pretty lousy year for markets. And I think a lot of people also are coming off a period where they were paying more attention to equity markets in particular during the pandemic when they were home. Going into 2023, if you're talking to somebody who's 25 or 45 for that matter, and they want to build their wealth, they want to think about retirement, what do you say to them? Is it a time to get into stocks? Is that the best strategy?
Of course, if somebody is 25 worried about their retirement, you have to say what kind of person is this?
Maybe not worried, but they should, it's a good idea to think about it.
I guess what I would say is the best time to invest is when markets are depressed. And right now the markets are a little depressed. The stock market was down between 20 and 30%, depending on how you measure it last year. So I suspect that it's a pretty good time to invest. You never can time the bottom of the market exquisitely well or the top. But you should basically say, look, the economy has some problems. People are pulling money out of the market. That makes it cheaper and therefore time to get in. So I think it's actually a good time to invest.
David, of course, you're a seasoned, experienced investor, but throughout the COVID pandemic, we've had a lot of new investors come into this market, meme investors, whatever you want to call it, a lot of new retail investors. How do they go upon improving their financial literacy and picking good stocks to own?
Well, you can't read too much, so I think people should try to read more about what they're investing in. Very often they might hear a stock tip from a friend, all of a sudden they're buying the stock. They should read about it, learn more, and don't rush to do something. But there's nothing more important than reading, knowing what you're investing in, and making certain you keep current with it. And I tell people in a book I recently wrote about investing that you have to really know what you're doing before you give your money to somebody.
I also want to talk to you about the outlook for M&A, since that is your business. We earlier talked to Paul Knopp of KPMG, where he said, particularly in the second half of the year, we might see more of an uptick in deals. What's your view?
Well, hopefully it'll be better in the second half than probably the first half. The first half is still going to reflect a little bit of what we saw in the last half of 2022. Right now, this is the phenomenon you have. It's harder to borrow money, for sure, but that isn't the biggest problem because a lot of deals don't need money. You have growth capital, venture capital. The real problem is people who see the economy right now, they think the economy is going to come back and they don't want to sell at a lower price. And the sellers or the buyers are saying, wait a second, we're going to recession, so you should sell at a lower price. So there's a big gap of, I would say, 20 to 25% between buyer and seller expectations. And that's the biggest problem we have right now.
What's your go-to tool that you use to size up a deal and ultimately know when to pull the trigger?
Well, at a firm like Carlyle, you have gigantic investment committee memos. So typically, if you're going to do a deal, you'll have a 30, 40, 50-page memo, which you could argue that Warren Buffett doesn't use 30 and 40 and 50-page memos. But reading that memo and making certain you talk to the people who've done a lot of the due diligence is probably the best thing to do. For those people who don't have deal teams of the size of Carlyle, they obviously have to read material and make sure they know something about what they're investing in.
I want to talk to you a little bit about Carlyle and the whole succession discussion at the firm. There have been a lot of rumors about the Citigroup CFO potentially, about a former Morgan Stanley executive, about different people who might come in to run it. Well, how are you guys thinking about it right now? Where are you in the process?
I don't really think I can comment on that because I've been trained by my lawyers that I will go to jail if I say something. So what is your next question?
Where would you like to see Carlyle a decade from now?
Well, the greatest private equity firm that's ever existed. That's what I'd like people to say, but I have to be realistic about it. A decade is not that long a period of time to really build a firm to that level. I think it's one of the biggest and one of the most successful private equity firms in the world. There are probably 20,000 private equity firms. It's one of the most successful. But sure, I'd like it to continue to be active and well regarded. And people think that if you work there, you're going to get a good job and good training. And if you invest there, you're going to get a good return.
By what metric? If it's the best private equity firm in the world, how do you measure that?
Well, it's one that my children would say they're proud that their father started, I guess. And if my mother was still alive, she would call me and say, hey, you really did a good job. So, but in terms of the metrics, you want people around the investment community to say this is a firm that people should work at. It's a great place to work at. It's a place where you should invest your money. No perfect metric, but those are the ones I use.
Dave, before we let you go, big fan of what you do interview-wise, and you wear a lot of hats like Julie mentioned. What makes you tick?
Well, I came from very modest circumstances. I'm trying to give back to the country and try to say, look, people from modest circumstances, they work hard, they can achieve things in life. And I'm motivated by, trying to please what my parents wanted me to be, which is to something useful with my life. So, the country's been great to me, and so I want to give back to the country, and that really motivates me.
I'm sure that your mother would be very proud. I think.
Well,
I
hope so. But she lived to see a lot of what I've done. But I think she was happy. But I think she never is happy as when Carlyle bought Dunkin' Donuts, and I gave her free Dunkin' Donuts coffee passes, and she would go into Dunkin' Donuts place and say, my son owns Dunkin' Donuts, and the person would roll their eyes and say, sure. But she would give them a little pass, and she'd get free coffee. She was happy about that.
That is fantastic.
Awesome.
Thanks so much, David. David Rubenstein
Bye.
of the Carlyle Group. Thank you.
Microsoft confirming it plans to cut 10,000 employees, which is about 5% of its workforce this year, as the entire tech industry deals with a continued slowdown. D.A. Davidson technology strategist Gil Luria joins us now. Gil, help us put this in context here. 5% of the workforce at the same time when we know that there are a lot of tech companies that have been guilty perhaps of overhiring, but put this kind of in perspective with regard to what this signals about Microsoft's future ambitions as well.
Well, for Microsoft specifically, this is a tactical move to realign resources from the businesses that aren't growing and they don't expect to grow over the next couple of years to places where they do expect growth. And specifically, there's a big investment being made right now in AI, in OpenAI, the company that they're seeing really good results from ChatGPT. But they do need to divest from some of the businesses that are just not going to show a lot of growth over the next couple of years.
And Gil, I'm just wondering, I know some of these tech workers personally who've been laid off and then hired at a different firm. And usually, at least in the limited sample space I'm looking at, it doesn't take that long. I'm just wondering if there are any stats of whether these hires, well, I guess these layoffs persist and we have a pool of talent that suddenly is trying to clamor for a job and can't find it.
Well, I think we've had a deficit, especially of technical workers, of coders in the industry for the last several years. And so as people are getting laid off, they're very easy for them to find new job, get absorbed. And I don't think that's going to change for a while. The demand for programmers, for coders is so substantial that that's not going to change anytime in the near future. Longer term, I'd go back to the conversation about generative AI and think about how much of that capacity for coders can be filled by generative AI. But for the next year or two, I'd expect a lot of these layoffs to happen and for those people to be absorbed at other places where there is growth, where they do need more technical talent.
Gil, our team has been boots and parka on the ground in Davos as the World Economic Forum is taking place. And they got a reaction from Ian Bremmer of Eurasia talking about tech CEOs and saying that they're ruining American democracy. I want to play the clip and get your response on the other side.
That's Elon Musk, that's Jeff Bezos, that's Mark Zuckerberg, it's all these people. But the fact is that those people worth hundreds of billions of dollars also, at the same time, have literally no interest or conception in their role as stewards for civil society and American democracy. That is the different sides of the absolute same coin. And all of America's lionizing free markets and capitalism has also led to a vastly more dysfunctional democratic process because these companies are inadvertently, but nonetheless, aligning with business models that destroy democracy.
Gil, you cover many of these companies. What would you say in response to the statements that you just heard from Bremmer?
The CEOs and management teams that we deal with are very concerned with adding shareholder value. They try to stay away from politics and the topics around politics as much as they can. Now, Mr. Bremmer mentioned some of the top billionaires and founders of these firms, and they have their own political views and they're exercising in the way they want. But most of the companies we cover, including the biggest ones, are really just focused on shareholder returns and making sure that their business grows in an ethical, profitable manner. So I think that's probably, there's a couple of people that Mr. Bremmer mentioned that should be a concern. It's not a concern about the companies themselves and not the stocks either.
Oh, okay, so I guess this raises more of a kind of existential equity market question then. And should the value or that fiduciary duty to shareholders outweigh kind of the ethical and civic responsibilities that technology companies and their products and services have?
We do have expectations from these companies to act ethically, and their shareholders have that expectation from them as well. That's one of the things we've seen from the growth of the ESG movement, is that the expectation is for these stewards of capital to manage and balance what they're doing for their shareholders with what they're doing towards their stakeholders. So that's definitely on their mind. But again, I go back to the fact that the companies we interact with and cover are doing just that. And they have a very strong commitment to their stakeholders and to their employees. Many of these companies that we're talking about are some of the highest ranked companies in terms of best places to work. And the reason is they do take care of their stakeholders and they do take care of their employees.
Gil, before we go here, I want to direct your attention to the Wi-Fi Interactive. Just going to broaden the picture out, compare software to chip stocks. Now, this takes a benchmark, and you can use any one here. The iShares Software ETF, IGV, over the last year versus the iShares Semi-ETF, Semiconductors ETF, SOX, and you can see they're both down about 23%. But when you take a look at the 3-month returns, SOX here is up 27%. And I remember last November, December, those chip stocks were really getting beaten down. What do you think is causing the turnaround here for chip stocks just first before software?
Well, chips and chip stocks have always been trading stocks. They live by their own cycle, which makes it very lucrative to figure out what the cycle is and call the top and bottom on it. They don't really add that much value over time. I'll contrast that with software companies. Software companies are one of the main drivers of productivity in the economy. They add value over time. Their underperformance over the last year or two has been spectacular from very high levels as interest rates have gone up and discount rates have gone up. But over time, these are the companies that add value. And over time, we expect them to far outperform other parts of the technology ecosystem and the economy, specifically chip stocks. But chip stocks will outperform during their cycle and then underperform during the other end of their cycle.
Well, I appreciate your being candid here and honest. Thank you, Gil Luria, D.A. Davidson technology strategist. Coming up, Treasury Secretary Yellen, she's warning of extraordinary measures to come if lawmakers do not raise the debt limit. We'll discuss next.
Welcome back to Yahoo Finance Live. I'm Jennifer Schonberger. Well, Treasury Secretary Janet Yellen sent a letter last week to House Speaker Kevin McCarthy warning that the U.S. will hit the debt limit Thursday, tomorrow. In that letter, she noted that the U.S. can take extraordinary measures until roughly early June before the nation will hit the borrowing limit. Now, this as Republicans have threatened not to raise the nation's borrowing limit unless major spending cuts are enacted. Here to weigh in is John Rizzo, former Treasury Public Affairs official, I should say. He is now a senior vice president with the Clyde Group. John, it's great to see you. Welcome to the program.
Hey, Jennifer. Good to be with you.
So, John, House Republicans are reportedly formulating a plan where they would tell Treasury which payments to prioritize in the event that lawmakers in Congress are not able to raise the debt ceiling. Given your experience at Treasury, what is the prospect that Treasury would begin to prioritize payments if extraordinary measures did run out and there was a breach?
Well, Jennifer, there's one word for the House Republican plan, and it's default, because that's what it is. This idea of prioritizing payments is just default by another name. And so hopefully House Republicans move off this proposal, because it would be a disaster for the American economy, and it would lead the United States into default, which we cannot risk.
But John, are there any measures that Treasury could take in the event that extraordinary measures do run out? Obviously, we nearly defaulted in 2011. Is there a playbook or something that Treasury has stashed away that they can go to now?
Well, Jennifer, I think what I would tell people is to, having worked with Secretary Yellen, having worked for her, I would tell people to take her seriously, because Janet Yellen doesn't bluff. And when she says that this is an urgent issue that requires congressional action, it does. There aren't any magic wands or rabbits to pull out of a hat here. Congress just has to do its job, raise the debt ceiling, and prevent economic chaos.
What about this notion of minting $1 trillion coin? Some people have said that the Treasury could do that, deposit it at the Fed, and then draw on that to pay off interest on debt and so on and so forth. I know Treasury Secretary Yellen has batted that down in the past, but if we were in a dire situation, is that something that perhaps Treasury could turn to?
So there's a reason that Secretary Yellen has called this a gimmick, because it is. There is zero possibility that a gimmick like this would work or be seen as credible. And part of the challenge here, and part of the reason I think market participants, large businesses need to be engaged in a campaign to lift the debt ceiling, is because there aren't a lot of solutions. In fact, there's only one. And the solution is for Congress to do its job, come together, raise the debt ceiling to finance the spending that has already been authorized and appropriated.
John, in an op-ed on our website today, you compare playing with the debt ceiling to the January 6th insurrection, and you are calling on banks, corporate America, to really rally together and head a campaign to try to intervene and sway lawmakers to lift the debt ceiling in time.
Yeah, so this act of engaging and playing around with the debt ceiling has to be seen as the financial equivalent of January 6th. And what I mean by that is that businesses and major corporations have to be clear that there's no coming back from flirting with a default. And if a member of Congress engages in that kind of behavior, then political support should go away forever. And additionally, support should be channeled to candidates, whether they're Republicans or Democrats, who actually will commit to raising the debt ceiling and preventing a catastrophic default.
John, unfortunately, we'll have to leave the conversation there, but we thank you so much for your insight. Hope to see you soon.
All right, thanks a lot.
That's John Rizzo, former senior public affairs official from the U.S. Treasury. You can find his op-ed on our website at finance.yahoo.com. We'll be right back.
Welcome back, everyone. You hear the music. You know what time it is. It's time for Cover Time. 3 stories, 1 minute each. Today we start with this. Elon Musk's Twitter is turning to auctions after reportedly falling behind on rent at its San Francisco headquarters. The social media company has partnered with Heritage Global Partners to conduct the sales, which include, get this, espresso makers and computers. Now, there were a lot of items that were rumored to be going up for sale in the weeks leading up to this. And so now we get a glimpse of exactly what is just getting chucked out the window and perhaps will hit the auction streets.
Yes, well, I got to tell you, there's a sign. I think there's a neon sign, says Twitter. It's been in there forever, maybe since the beginning. 17,500, I believe, is the price tag that they're looking for. They might get there. This is all cash in Elon's pocket. He might not have to sell incremental Tesla shares because of the money that's coming back to him. He stopped paying the rent, and you might laugh and say, well, this is only a few $1 million. It adds up. It's loose change for Elon, but it does add up.
Absolutely. All right, we'll see exactly what some of those selling prices go for in the auction.
All right, Netflix looking for someone to take flights in its new job posting, offering $385,000 for a new flight attendant to join its private jets based in San Jose, California. And I got to say, $385,000 for being a flight attendant is not bad money. And you got to think that the clientele might be a little bit more better behaved than the typical airline. Well, I would hope, or it might be worse.
Here's the thing, Jared. I took a look at the listing, and both of us are actually ruled out from it unless, you moved to San Jose, California, and I did not know it. But to my knowledge, we're both still in New York. So this is a San Jose, California-based role. So anybody who's on the West Coast or the Best Coast, tune in your ears to this one. It's actually a range here. I believe it's about $60,000 to $385,000 on the top end. Yeah. So you got to have all your certifications. You got to be assist with purchasing aircraft, stock, work ground duty days, and I think it goes between team meetings in Burbank and then also working out of the hangar in San Jose.
Sounds like they checked off a box to get this done in California, and guess what? They got a story out of it, free publicity as well.
There you go. Also here, AMC cooking up a new tactic to drive traffic, offering a 50% discount on popcorn to celebrate National Popcorn Day tomorrow. National Popcorn Day is tomorrow, and so AMC guests at all of its U.S. locations, they're going to be able to take advantage of some of these deals here. I was taking a look at AMC shares. It's actually one of the trending stocks on our Yahoo Finance platform today. It's up by about 1.2%. We'll round that off too, but just more on the deal if people are looking to take advantage of it.
I'll take a few details.
I don't like popcorn, so I'm just going to...
I love popcorn. I love a good gimmick. I haven't been to the movies in forever. I need to see Avatar 2. I got a lot. Things are stacking up here. I might go to the movies tomorrow evening.
I do still need to see Avatar 2. So if you're looking for a partner to see Avatar 2, I am happy to join you.
You got a movie theater right here?
Yeah, it's right around the corner. The details for the people who are interested, though, Stubbs members, they get a free refill on a purchase of large popcorn. A-list members, because that's where they're trying to get people more into the system there, they're going to receive a free upsize on popcorn, fountain, soda purchases as well there. But another effort to drive even more of that traffic into AMC theaters. Coming up, everyone, we're going to head back to Davos, where Julie and Sazi, they're going to share their interview with Eurasia Group founder Ian Bremmer. You do not want to miss it.
Welcome to Yahoo Finance. It's 11 a.m. on the East Coast, 8 a.m. on the West. I'm Rochelle Akufo. Here's a look at what I'm watching this hour. Weathering the storm. Stocks mixed amid signs inflation has peaked, but Goldman Sachs says investors are looking outside the U.S. But where? We take a look at a sector that's expected to withstand a recession and get a big boost from China. Plus, bullish Bitcoin, the king of cryptocurrencies, extending a winning streak. It's now on course for its best performance in a decade. But not everyone's convinced that winter is over just yet. We get the crypto temperature check from Davos. And danger, fiscal cliff ahead. House Republicans are pushing for spending cuts in exchange for an increase in the debt ceiling. White House says it won't entertain any such negotiations. We discuss a dangerous game unfolding in D.C. as time is running out. But first, let's take a look at how the major indices are faring. As we said, they're a mixed picture. The Dow, they're off almost about 0.5%. They're 152 points. The S&P, they're down about 0.1%. And the Nasdaq, the only one in the green, but just barely there, up about 10 points on the day. Let's also check in on the Treasury market as people wondering what's going to happen with recession fears. We're seeing here all three of the Treasuries here in negative territory. The 5-year down almost 4%, the 10-year down about just slightly shy of that, about 3.8% there, and the 30-year down more than about 2.33% there. All right, well, we're starting this hour with our eye on equities as 2023 shows a reversal in trends among investors who are now turning to non-US assets. That's according to Goldman Sachs. We have Yahoo Finance's Inez Ferrer here with the details and where investors are actually shifting regions they might want to keep an eye on. So, Inez, what are we watching?
Yeah, Rochelle, well, Goldman Sachs analysts have been taking a look at outflows over the last several weeks. And in the first 2 weeks of January, they saw some $5 billion in outflows into stock funds into Europe, into China, and other emerging markets. And that's because of a weaker dollar. It's also because of commodity prices that have been falling. So that's bullish for Europe, for example. And then over, of course, the optimism over the reopening of China. And so for a while, investors were only looking at U.S. assets and investing in U.S. equities, but now investors are looking abroad. The Fed is expected to continue increasing a rate somewhat, and so that is expected to have impact, for example, on tech stocks in the S&P 500, and capital really flows to where it's treated best. So as China is reopening, this is very bullish for companies which service China, which sell to China, where the demand is high in China, and that includes the luxury brands. So you had Burberry that just reported its quarterly results. Last quarter, the demand was muted in China because of those lockdowns, but Burberry's CFO is already talking about seeing a change in traffic patterns. That means that the Chinese consumers are traveling to places like Macau, to Hong Kong to buy luxury goods. Also, Richemont, that's the owner of Cartier, said that also sales are starting to pick up. And just another note, LVMH, the owner of Louis Vuitton, that stock in Europe today is hitting record highs. I want to show you what's happening with the luxury intraday chart here that you can see on our Wi-Fi interactive board. And it has been outperforming broader markets. I'm going to pull up a year-to-date chart so you can see the gains in these luxury brands year-to-date. And I'm going to pull up a one-year chart so you can see that compared to the broader market, these stocks have been outperforming for the most part.
It's always an interesting sector to keep an eye on to see why luxury is so resilient. Inez Ferrer there for us. Well, U.S. retail sales slide 1.1% in December, coming in weaker than economists' expectations as rising interest rates, elevated inflation, and economic concerns weigh on consumers. Here to discuss is Jerome Martis, Refinitiv Director of Consumer Research, along with Jose Torres, Interactive Brokers Senior Economist. Jose, I want to first start with you and get really your takeaway. So this was a bigger pullback than expected. What stood out to you in this report?
Good morning. Thanks for having me. Well, what stood out for me was the broad weakness across almost all sectors. Only 2 of the categories notched an increase. And we're seeing that the interest rate hikes from the Fed are really impacting the goods sectors as well as real estate. When consumers walk into car dealerships or to furniture stores, they find that the interest rates that they have to pay on financing are a lot higher than they were a year or 2 ago. And at the same time, banks are also tightening credit standards because they're playing defense due to a possible economic slowdown in 2023.
And Jerome, obviously some of these more interest rate sensitive segments coming down, anything involving loans, auto, some of these big household purchases, and also gas prices pulling down as well here. When you factor in gas prices, then how are you viewing this picture of how the US consumer is actually faring?
Well, despite the weakness across the board, year over year, it was a different story. We saw that the consumers did go out to eat at restaurants. And this is in line with our Refinitiv data that tells us that when consumers go out to eat, we're seeing that fine dining, casual dining are outperforming quick service. So they don't just want to order it and pick it up to take it home. They want to go into the restaurant, sit down, and have an experience despite the higher inflationary prices. So this comes, after being cooped up at home for 2 years. So this and also underlines the shift that we're seeing in consumer behavior, which is that they're moving away from buying things at the mall and instead spending their money for experiences and eating out or traveling.
So then when you look at some of the declines that we saw that were similar, non-store retailers, electronics, really contracting at that same pace between 1.1 and 1.2% there, are we getting a sense, Jose, that this inflation pullback is becoming more broad at this point?
Well,
sure, and that's...
I don't... Well,
Jose,
I
I'll
don't
have you
think
take that first, and then Jerome, you can weigh in.
Okay, sure. So services actually, based on the last consumer price index report, core inflation actually accelerated in December from November. So I think it's too early to declare a victory on services just yet. The labor market remains significantly out of balance with about 1.8 job openings for every unemployed person. And that's really keeping the pressure on employers to increase wages and keep them high to attract workers in labor-intensive services. So I think that on the good side, yes, we are having some sharp disinflation. Commodities, you got to be careful here with the winter, with oil, as well as food. Food has been sticky, and services as well. So I don't think we're out of the woods yet.
And Jerome, what's your take?
So for the holiday season, the fourth quarter, Refinitiv is looking at a 4.4% growth in revenue. So this is telling us that, yes, the consumer did spend somewhat during the holiday season, but given the higher inflationary cost, higher prices, and earnings are expected to take a hit. And those are expected to decline 21% for the fourth quarter. In fact, 10 out of the 11 consumer-related industries have turned negative, and only one is expected to be positive. So according to Refinitiv, the restaurant, the hotels, and leisure sector is expected to be the only positive sector for the fourth quarter, and everybody else is expected to see negative earnings.
So Jose, when you factor in what we're seeing, not just with consumers, but also what this means for Fed action going forward, how do you see this impacting equity markets going forward?
Well, I think equities are really challenged at the moment from a fundamental perspective. Earnings are expected to contract by our group, like my fellow panelists said earlier. Also, technicals, you're running up at that 200-day moving average, as well as that 12.5-month downward trend line from January 2022. You also have valuations that are particularly expensive. When you compare the equity market to what we're seeing in the fixed income market, very attractive yields that are investment grade. And for those that want to parse through some of the distressed areas in the high yield segment, you can actually find some returns that rival traditional equity returns. And finally, you have the Fed. The Fed understands the lessons of the 1970s and 80s, and they no longer have the disinflationary forces of globally integrated supply chains and low commodity prices helping their effort. They know that as soon as they take their foot off of the monetary policy brakes, there's a significant risk of inflation reaccelerating. And Chair Powell and his colleagues want to put the inflation genie back in the bottle for good. So I think they're going to stay high for longer, above 5%, and remaining at 5%, even though they're not raising, that's still restrictive. And I think the market is having a very difficult time understanding that, because when I see what the market's pricing in versus the Fed's summary of economic projections, there's a wide discrepancy there.
And Jerome, are you seeing this discrepancy? Obviously, a lot of people wondering if the Fed should perhaps take a bit more time, let the medicine take hold as they are looking at some of this lagging data. What are you seeing in terms of how the markets are reacting versus the data points that are coming out?
So we're more focused on the consumer, and our latest Refinitiv Consumer Confidence Report is telling us that going into 2023, consumers are very much concerned about their job security, purchasing power, and future expectations, which is a total difference than what we saw the previous year in 2022. Back then, in the beginning of the year, consumers were very much engaged because they felt secure in their job. And lately, we're seeing that a lot of the tech companies have announced a lot of layoffs. So if consumers start to see that their inner circle, their group of friends and their families are worried about their job security, they're going to put their hands in their pockets and hold back on spending. This is already being projected in our expectations for earnings. Retailers are also telling us that when consumers come into the store, they have to offer a promotion in order to entice them. In fact, so much so that in a collaboration with StyleSage, we discovered that the discount penetration, the amount of merchandise on sale has gone up significantly, and we're back at pre-pandemic levels, telling us that unless the consumer sees a promotion or a discount, they really don't want to open up their wallets. They really don't want to spend. So what you're seeing then is there's been a shift in consumer. They don't want to shop at the mall, but if they do, they want to have a promotion, and this is affecting earnings and gross margins for retailers.
I mean, especially when you factor in the cost of groceries still going up, among everything else. A lot of discretionary spending decisions consumers are having to make. A big thank you to our panel, Jerome Martis, Refinitiv Director of Consumer Research, along with Jose Torres, Interactive Brokers Senior Economist. Thank you both this morning. All right, coming up, getting a tailwind. Bitcoin is edging towards its longest winning streak in nearly a decade. The turmoil for the sector never seems far behind. We'll head to Davos for the Alpine take on all things crypto. That's next. Turning now to the crypto space. Bitcoin off to a promising start this year as it seems to be shaking off negativity from 2022. Now, the biggest cryptocurrency approaching its longest span of gains in nearly a decade. Following the fall of FTX in November, it had been trading below 18,000, but as inflation begins to settle and with the chances growing that the Fed will slow its rate hike strategy, the crypto backers have returned, pushing up the total valuation of the sector. Well, as for the crypto presence in Davos, last year it was all the rage, while this year it seems to have taken a back seat. For more on what the word on crypto is at the World Economic Forum, let's check in with Yahoo Finance's Julie Hyman and Brian Sozzi. Hey, guys.
Hey there, Rochelle. That's right. I mean, there has not been, if you look at the presence on the promenade of various corporations and brands, there's a lot of blockchain. There's not a lot of cryptocurrency, so to speak. There is Circle, and we'll be speaking with the CEO of that company, Jeremy Allaire, but it's really blockchain, not crypto so much.
Yeah, a lot of folks, usually a lot of the Bitcoin people showed up at the past couple Davoses pre the COVID-19 pandemic. No real presence here. Why? Because some of these companies are straight up out of business, Julie.
Well, and also because of Sam Bankman-Fried. You know, I have to say I ran into Anthony Scaramucci of Skybridge, and he sort of was like, Sam, because he has been an investor in that space. And Sam Bankman-Fried sort of helped trigger what, the ripple effect from the collapse of FTX. We also spoke to somebody else who is very negative on crypto, and that is Nouriel Roubini, the economist. Besides just being a little bit pessimistic on the overall economy, he had some interesting words on crypto and blockchain more broadly.
FTX and SBF are not an exception. They're a rule. Literally 99% of crypto is a scam, criminal activity, total really bubble, Ponzi scheme is going bust.
And I have more from Roubini's comments on crypto now on the Yahoo Finance homepage in a story. But Julie, of course, Roubini had that dust up with CZ over at Binance. I called them, I believe it was comment at a conference in late November. Of course, CZ wasn't feeling that one. But Roubini, very outspoken on people. They should not go anywhere near crypto.
Yeah, and Rochelle, he wasn't too excited about blockchain either.
I can understand that. It's a tense environment at the moment. And I understand, speaking of outspoken, you also spoke to Ian Bremmer as well. Tell us a little bit about that.
Yeah, the Ian Bremmer conversation, Rochelle, is really a focus on global activity, what is happening with the Russia-Ukraine war, what's happening with the economy. Here's what we put to him.
It's always helpful to have global leaders finding a place to engage and talk together in person, and that's particularly true after a few years when no one was traveling with the pandemic. But let's be clear, having a fragmented world means the WEF is suffering from that fragmentation. I mean, this is the first time in our lifetimes that a member of the G20 has been basically defenestrated, right? They've been decoupled from Europe economically, from the G7, from the wealthy world, and they aren't allowed at Davos. That's a problem, right? They're a major commodities producer for the world, and of course they're also the largest nuclear power in the world. So what we're seeing is a number of rogue states that are becoming more influential on the geopolitical stage that aren't aligned with any of the policy conversations that one would normally have at a forum like this. You also have China, which is not a rogue state, but they're trying to build their own competitive architecture. I mean, they show up here, but this isn't like Belt and Road. It's not like the Shanghai Cooperation Organization. It's not like other organizations that they are building that they intend to be aligned with Chinese market principles, state capitalist principles, Chinese political preferences and priorities. So in that regard, the idea of can we find cooperation is a question mark in a fragmented world. The WEF for 50 years is driving globalization, and increasingly globalization doesn't have the world in it, and that's a problem.
Very small presence here for China, and you just said you don't see China as a rogue state. Why not? Shouldn't they have more people here?
Well, yeah, but the fact they don't have people here doesn't mean that they're a rogue state. I mean, look, a rogue state is a country that you are literally disengaged from. U.S.-China relations are actually pretty robust in terms of the amount of engagement. It's just there's a lot of competition over Taiwan, over the South China Sea, over semiconductors, over human rights issues. But there's also immense amount of interdependence, as Yahoo Finance knows very well. And most everyone that is at the WEF wants to ensure that you continue to have a level of economic interdependence between those two economies. And also, let's keep in mind, it's not just the private sector. It's also American allies all over the world really don't want to be forced to choose between the United States and China. The Americans are very aware of that. So when Biden met with Xi Jinping at the G20 in Bali just a bit over a month ago, both leaders really tried to put a floor under the existing relationship. So yes, we're going to compete hard. Yes, there are lots of areas that we have zero trust for each other, but that's not going to break the relationship. U.S.-China will not become U.S.-Russia. That's really important.
Well, I want to get back to Russia for just a second here, because we've entered this pattern now where we're sort of getting used to the situation, both from a markets perspective, a political perspective, that they are this pariah state effectively at this point. Since we are sort of getting used to it, are global markets, global political systems sort of underestimating the threat that it still poses?
Certainly, anyone thinking about investing in Europe is underestimating it because it's so structural for the Europeans. First of all, I mean, energy supply is permanently shifted to anything but Russia. Those gas pipelines, which have actually been blown up, Nord Stream 1 and 2, are not coming back online.
And we've been lulled by the warm winter, so it hasn't been as severe as thought. But that's
it's still an expensive
that could change.
And permanent structural change. Well, if anything, it's probably going to get warmer. So, but leaving that aside, the fact that you have millions of refugees from Ukraine living in Poland, housed by the Europeans, that's a big deal. The fact that the Europeans are now going to have to spend vastly more on defense than they had to over the last 30 years. That is a constraint on what they can use their fiscal balances for domestically. That's new. That's a permanent change. And so, I mean, I think what we have to understand is that there's been 30 years of peace dividend that the Europeans have benefited from. It's over. And we're not in a cold war with Russia. We're in a hot war with Russia that we're fighting by proxy in Ukraine. But Russia's ability to use disinformation, to engage in cyber attacks against critical infrastructure, to blow up pipelines or fiber, to have proxy engagement and terrorism on the ground in NATO, those are now active threats that Europeans principally are going to have to defend themselves against. That is absolutely underpriced in the markets.
Looking at in the U.S., Ian, you write about the divided states of America. Take us through that thesis or that call out, and what does that mean to investors?
It means, thankfully, less than it used to. First of all, our top risk list, which is 10 risks a year that we put out at the beginning of every year, it's on the basis of likelihood, imminence, and impact. So the fact that the U.S., the world's most powerful country, the largest economy, is only number 8 means it almost doesn't exist on the list. And that's because you don't have a proximate risk in the U.S. of a constitutional crisis that many had been worried about for 2024 before the result of the midterm elections, when you had all of this potential for election deniers, when Trump looked a lot stronger, all of those things, right? Also, you do have the Americans coming together despite the dysfunction and divide on some significant landmark pieces of legislation. Think about the misnamed Inflation Reduction Act. Think about the CHIPS Act, for example. You also have broad consensus on a lot of national security policies, like on Russia, like on China, like on North Korea, like even on Iran, with Democrats and Republicans. Just this morning, I briefed the entire congressional delegation, and the level of alignment between all those Democrats and Republicans on those core foreign policy issues is much greater than you would ever see on cable news. I think that's meaningful.
I want to ask you one final question with regards to the U.S. specifically, and that's on big tech, because you called out sort of the power of individual big tech leaders in your risks as well, although it wasn't on the tippy top, but it was. You discussed it.
Yeah.
From an investment perspective, how much of a risk is that both of regulation coming in, but also that sometimes these people, like in Elon Musk, for example, are unpredictable for investors, et cetera?
I think it's less of an investment risk from a macro U.S. economic perspective. It's more of a risk to U.S. democracy. The fact is that the United States has attracted the most extraordinary entrepreneurial talent in the world. And I'm very proud to live in a country where that's true. And not all of them were born in the U.S. A lot of them were born in other places. They came to the U.S. because they understood that. That's Elon Musk. That's Jeff Bezos. That's Mark Zuckerberg. It's all these people. But the fact is that those people worth hundreds of billions of dollars also, at the same time, have literally no interest or conception in their role as stewards for civil society and American democracy. That is the different sides of the absolute same coin. And all of America's lionizing free markets and capitalism has also led to a vastly more dysfunctional democratic process, because these companies are inadvertently, but nonetheless, aligning with business models that destroy democracy. And they're exporting it too. That's a very serious problem that right now there is not even the beginning of a regulatory process to address.
So you think those tech CEOs just have too much power, and how does the government reel them in ultimately?
I don't think the government is reeling them in.
Should they, though?
Should they? I mean, the question, in this sort of an environment, everyone understands that generative artificial intelligence is a massive problem, deep fakes, disinformation, all the rest. And yet, until you have a major crisis, the people are talking about hundreds of different issues. Democrats, Republicans, they don't agree on what should be done. They don't agree on what the problem is. Some people want to break them up. Some people want to regulate them harder. Some people think it's all about free speech. Some people think it's about woke capitalism. I mean, you know, you pick a congressman, you have a different issue with AI, right? And so I would say until you have a serious crisis, how long did we ignore? The Russia war in Ukraine has been going on for almost a decade now, completely ignored until they actually decided they were going to overthrow Zelensky and invade Kiev. We have not come close to that moment yet on AI, and until we do, we're not going to have a regulatory response.
You mentioned Elon Musk. Do you think it's, we are running a potential crisis of him running Twitter unchecked?
I wouldn't only focus on Elon Musk and Twitter. I would talk about Facebook. I would talk about TikTok. These are literally platforms where the A/B testing they're doing is about how can we better addict our product. And our product happens to be citizens of the United States and other democracies around the world. There's a reason why the Chinese government hasn't allowed these platforms to exist in their own country. When they do, they're very, very different organizations.
Well, that was Eurasia Group founder Ian Bremmer there, alongside Yahoo Finance's Julie Hyman and Brian Sozzi at Davos. All right, coming up, activist action. There's no doubt the media space has seen more than its fair share of attention from shareholders looking for big changes. But do they see the changing landscape as an easy target? We discuss next. Disney has fired back at activist investor Nelson Peltz, rejecting his bid for a seat on the group's board while staunchly defending CEO Bob Iger. It said the head of Trian Fund Management had no track record in large cap media. Well, from the New York Times to Nielsen, the sector is increasingly the target of these types of campaigns. So is the drama at Disney, just another example of a trend that's set to continue. Yahoo Finance's Ali Kanal has more on this. So, Ali, what are you watching?
Well, Rochelle, there certainly has been an uptick in the number of activist campaigns, especially in the back half of last year. According to data from FDI Consulting, there were 119 activist campaigns in the third quarter of 2022 versus just 87 in the year prior. And there were notable increases in the number of campaigns focused solely on operational changes and divestitures. In regards to Disney specifically, if you remember back in September, Disney and Third Point's Dan Loeb reached a settlement to add one director to Disney's board after Third Point was arguing for an ESPN spinoff and acceleration in that timeline when it came to Disney buying out Comcast's 33% share in Hulu, among other demands. So Disney in particular has been very vulnerable here, especially as the media sector seems to be going through this reckoning. $500 billion was wiped off large and medium caps for a lot of those media companies last year alone. There's been an increased focus on profitability, a lot of competition entering the space. So there is this opportunity for activist investors to come in and say, hey, look at this stock. It's underperforming. I have a way to help. Disney not immune to that, with shares falling 45% in 2022, the worst annual stock performance for the company since 1974. And really, these activist investors are trying to find ways to close that valuation gap due to these depressed stock levels. And that's why we're seeing a lot of calls for spinoffs, a lot of calls for breakups. So I do anticipate that these activist investors are going to be more aggressive in 2023. We already saw that happening in 2022. And certain sectors like media, telecommunications, and even healthcare are certainly more prone to that.
And you figure as they're trying to really figure out what the customer wants these days, this is getting tougher. And Ali, of course, Disney's saying that Peltz lacks the skills to assist the board and doesn't understand the business. But could this proxy fight force Disney to make certain changes at the company?
It definitely ups the pressure for Disney, but I do think it's important to remember that Bob Iger re-entered the CEO position in November. That was not that long ago, and we haven't seen a ton of strategy from Iger since that time. Sure, he's dismantled a lot of those organizational structures that former CEO Bob Chapek put in place. Those were already a bit controversial, but other than that, we haven't gotten a lot from Iger. And I think moving forward for Disney, it's very important for this company to establish its identity. What does it need in order to get to that next level? What assets does it need to cultivate that identity? And what could it possibly do away with? That is the most important element for shareholders. Nelson Peltz, these proxy fights, it's all just a distraction at this point. And that's really the narrative that we've been hearing from a lot of analysts. So we'll have to wait and see when it comes to Disney. But I think, number one, they need to establish who they are as a company.
Exactly, because that really will determine the kind of changes that they have going forward. Ali Canal, thank you for that update. All right, coming up, don't look down. As the debt ceiling concerns ramp up, we'll take a look at the very real impact any deadlock could have on the U.S. economy in the months to come. That's up next. House Speaker Kevin McCarthy looking to coax Democrats back into talks about the debt limit after a clear rejection from the White House. The political maneuvering comes even as key officials warn of the risk of default. Well, joining us with the latest out of the Beltway is Yahoo Finance's Rick Newman, a battle we've become all too familiar with, unfortunately, Rick.
Oh, my God. And this is all we're going to be talking about politically for the next 4 months, I'm afraid. So, I mean, the posturing has begun, and this is just the way it's going to go for the foreseeable future. McCarthy is going to say, look, Democrats need to talk and make some deals with us about cutting federal spending. The Biden administration and virtually every Democrat in Congress is going to say, we're not negotiating anything. Republicans need to agree to simply raise the borrowing limit without conditions. And it's probably going to go down to the wire. So the next question is, well, when is it going to go down to the wire? When is that going to actually happen? And the best guess around now is maybe by early June, the Treasury Department will be running out of its ability to move money around and pay the nation's bills. So we're going to have a showdown here at some point in 2023, and it'll all get resolved, but it's probably going to be pretty ugly before that happens.
It usually does, doesn't it? Rick Newman, thanks so much for that update. All right, well, now let's turn to what's driving much of the discussion, when the Treasury will run out of money to pay its debts, and whether lawmakers could potentially miss or underestimate that date. Here to discuss is Shai Akabas, Director of Economic Policy at the Bipartisan Policy Center. Thank you for joining me today. So, Shai, I know that obviously Janet Yellen had her prediction. She put it as Thursday, as this so-called X date, when that date would be. But what are your models saying? What are your predictions?
Yeah, so it's an important distinction, Michelle, it's great to be with you, that tomorrow is when we will actually reach the debt limit, which means that we have come up against that $31.4 trillion that is set in federal law that the Treasury Department is not allowed to borrow beyond. That's a significant date, but it's not the one with the major economic consequences attached. That's because the Treasury Secretary has some tools at her disposal called extraordinary measures. They're really just accounting maneuvers that are allowed by law to give her some additional breathing room and really give Congress some additional breathing room to act. She will start deploying those measures tomorrow when we run up against the debt limit. And then we expect that they will last for a period of time, likely several months, until sometime around the middle of the year. We don't know exactly when that X date, as we call it at the Bipartisan Policy Center, which is the date on which the Treasury Department will not be able to pay all of our bills in full and on time. We don't know exactly when that will arrive because it depends on literally millions of payments that are going in and out of the Treasury Department each day. But we expect it will arrive sometime around the middle of this year, meaning that if Congress does not act before then, we would be failing to meet some of our obligations as a country, which would be unprecedented in modern times.
And Shai, some of the biggest things that are really shifting the needle here, potentially what we saw with the student loan debt that President Biden had put forward, the relief there, whether that goes in or not, how much does that move the needle on this?
Yeah, there have been several policy developments over the course of the second half of last year and economic developments that have led to an X date that we expect to be somewhat sooner than it otherwise would have been. So, for example, the extension of the student loan pause that has been ongoing since roughly the beginning of the pandemic, that was announced to be extended now until roughly the middle of this year. That means that student loan payments that would otherwise be coming into the federal government from borrowers are not being received, which means less receipts and more debt that needs to be issued from the Treasury Department. That will accelerate the timing of the debt limit. Similarly, when interest rates are higher, we have higher payments on our government debt that's outstanding. So that will also mean more spending and thus more debt, meaning a sooner X date. So all of these factors are driving the timing a little bit closer. All that said, Congress has plenty of time to act on this. They just need to get themselves together, figure out how they're going to proceed, and pass legislation. They have many months of runway, but often they leave these decisions until the last minute, which is not good for the economy.
And Shai, as part of an effort to really avoid keep from coming to this brink every single time, we know that back in 2021, there was a bipartisan bill that offered some additional ways to stop us from getting to this point, giving the president powers to act in certain situations with Congress. How far do you think that could get now in this sort of environment? Is there an appetite for some sort of permanent solutions to this?
There is a growing appetite for that because both parties are increasingly realizing that the debt limit is serving nobody's purposes in its current form. It is extremely risky and potentially costly if we actually were to go beyond that X date. And it also is not achieving fiscal responsibility, which is at least the stated purpose of what some people believe it should be there for. In recent debt limit deals, we've actually seen spending go up, not down. It is not serving as that focal point for fiscal responsibility. We need a better paradigm. And this legislation that has been introduced in the House of Representatives on a bipartisan basis represents that change that would de-risk the debt limit, stop us from coming up against it each year in a way that poses this risk and potential harm to the economy, but also forcing a debate in Congress, which we don't have often enough, around spending and taxes and how we are going to get our fiscal house in order.
And so for people who are wondering, if they do go beyond this X date, what are some of the most immediate repercussions that your everyday American would see? How would they see this reflected?
That's the $64,000 or really the $1 trillion question in this case. We don't know is the honest answer because we've never been there before in modern times. It would be uncharted waters for the United States to not be meeting all of its obligations. We are the bedrock of the global financial and economic system. Anything that turns that on its head is going to be extremely concerning to market participants, investors, other global actors. It could mean a significant drop in financial markets. It could mean a spike in interest rates. It could mean that we, at some point, no longer are the reserve currency of the world. We have been entrusted with that because of the faith that people have in the US dollar and US Treasury securities. If that is no longer the case, we could face severe economic consequences. These are all risks. We don't know what that world would look like, but it could impact Americans in their everyday life through higher interest rates, economic pullback, and potentially leading to higher unemployment. These are all factors that could come into play if the Treasury Department was unable to meet all of our obligations in full and on time.
Certainly too much at stake to keep kicking the can down the road. Hopefully we do end up with a more permanent solution. Shaya Karbas there, Director of Economic Policy at the Bipartisan Policy Center. Thank you for joining me this morning. All right, coming up, getting ahead of the game. Paying off your own college tuition can be hard, but what about planning for your kids? When should you start? Maybe even before they're born? We'll get some tips from an expert. That's up next. save for college or for retirement? Well, it's a question facing many young couples at the crossroads between childcare and future planning, and of course a reflection of just how expensive college tuition is becoming. Joining us now is Aaron Ulrich, Family Wealth Strategies financial advisor. This is part of our Financing Your Future series brought to you by Synchrony Bank Savings. So Aaron, good to see you here. Obviously a lot of people wondering, they're trying to decide, you have that guilt. Should I be putting in more for my child's college? Or, you have retirement approaching too. How do you figure out which one is the best approach?
Yeah, it's a big question. It's a big deal for working families. They have two things they want to accomplish. We want to take care of our kids and we want to take care of ourselves. The conversation usually starts with the idea that there is not a loan for retirement, okay? There is loans, there are grants, there are scholarships for college. There's no scholarship for retirement. So we've got to be really aware of what the risks are when you're dividing up your family's finances.
But couldn't you simply take out like a personal loan or perhaps a home equity loan in your elder years if that's something? Wouldn't that be an alternative as well?
It'd be an alternative. I don't think it's a good alternative. I don't want my clients looking for loans and trying to finance retirement. We want to go, and most of my clients that I work with, we work with a lot of folks who are in retirement, taking retirement income. And for most of those folks, they don't want debt when they're retired. They don't want to be trying to take the equity out of their homes. And so those decisions that you make early in life are what can set you up for a quality retirement. And if you're choosing to divert some of your family finances into college funding, you could possibly be doing that at the risk of not saving for retirement during some pretty key working years. So it's not an easy decision. It's a very personal decision. And families, our clients, we want them to understand the rules. We want them to understand what options are available to them, whether that's a 529 or how they're going to invest that money. But absolutely, if you're investing for college, saving for college, at the expense of saving for retirement, you could be doing yourself a very big disservice. Now, I'm biased. I'm a retirement planner. I don't consider myself a college finance planner, but I'm thinking about folks when they get to be 60, 65, 70 years old. We want to make sure that they have enough to take care of themselves.
So I want to talk timelines here because some people have been very good, had a 521 set up before their kid even, opened their eyes in this world. Others are perhaps maybe you have a 10-year-old and you're starting to panic a little bit. In terms of timelines, how should you approach then saving for college?
Yeah, so that's a great question. The 529, just so the viewers understand, that's a state-specific tool. So there's a lot of them, and it can get confusing. So you want to look at the rules for your state. Also, in the case of if it's a grandparent saving for a grandchild and the child lives in a different state, there could be different tax rules for that. So you want to be sure you understand the state rules. But your question was about timeline. When you're saving for retirement, you're in your 20s, 30s, 40s, that's a 30, 40 year, that's long-term investing. In your example, saving for a 10-year-old, well, for college, that's an 8 to 10 to 12 year time frame. That's naturally a shorter time frame, which limits the amount of growth that you're going to be able to get from any investment, right? The best investors in the world can't do as well in 8 years as they can in 30 years. And that's just the limits of what the markets do. And so you bring in some other factors there. The time frame is huge, and your personal risk tolerance. What if the market's down on the day the kid graduates from high school, and that's the year the markets were down and all of those gains went away? Additionally, with a 529, it gives you a tax break on the growth, right? So that's a good thing, the same as a retirement account. However, you only have 8 years to grow it. So if you don't get a lot of growth, that 529 may not be the best vehicle for short-term savings.
You certainly raised some interesting points there. And the timeline thing is very important. I know a lot of people might be hitting the panic button as we speak. A big thank you there, Aaron Ulrich, there, financial advisor at Family Wealth Strategies. Thank you for joining me. All right, coming up, brace position. The Wall Street Journal is out with its best and worst airlines of 2022. The former must be shortlisted after a chaotic year for the industry. We'll deep dive into that story next. The Wall Street Journal published its 15th annual airline scorecard ranking the US's major airlines. Let's get to Yahoo Finance's Brad Smith for analysis of the best and worst flight operators. Any surprises here for you, Brad?
You know, it was an interesting list, and there were a few surprises peppered in, but I think one that's no surprise is what took the top here. Let's take a look at the scorecard. Delta actually came in at the top here, and it actually ranked higher in 3 categories than any other airline here. So it was number 1 in 3 categories, and there were a range of categories, everything from who was doing the best in terms of complaints, who was managing luggage the best as well, and then who was just on time or who was delayed the most. And so there you're taking a look at some of the rankings, the scorecards. I was actually surprised that Alaskan Airlines did as well as they did, but that came in at number 2 and then Southwest at number 3. So those were your top 3, and you can see where some of the rest stacked up. JetBlue bringing up the caboose here. And let's take a look at some of the year-over-year performance to see where airlines have trended. And one thing that you can make note of is the fact that Delta, yeah, they've held on to that number 1 position for 2 years now. However, one of the biggest moves that we did see to the downside, yeah, that's Spirit here. Went from number 4 all the way to a net number 7 at the end of the day. And then additionally here, we're kind of looking at JetBlue. And one interesting thing about where all of these airlines ranked, I mentioned Alaskan Airlines and how they came in overall at number 2. They were actually the second worst, though, in mishandled baggage. Only American Airlines did worse in handling people's baggage. However, on the other side of this, you had Southwest that was actually the best in complaints. However, with a caveat there, because this was actually measured over 12 months that concluded in October. So perhaps some of those cancellations and the headaches that really plagued travelers who were flying with Southwest over the 2022 holiday season, that best showed up or was apparent in some of the canceled flight recordings as well there, because that was more of a full year scope there, Rochelle. So that's where we really saw that kind of stack up. And in terms of some of the stock price movement here on the day, on this report, because at the end of the day, it's a question of how investors evaluate this, but also what do consumers read into this and how does this change their own perception and perhaps who they may book with in the future? You're taking a look at some of the travel stocks here on the day, and and this is on a 1-year basis. I'm going to put this on an intraday basis here so we can get a good look at things. United Airlines, you're seeing that lower by about 2.5% on the day. It's important to remember that that's a company that did just report earnings as well, and they just had their call at 10:30 a.m. Eastern time. So that's down 2.5%, perhaps moving a little bit more on earnings. But you've got Delta Airlines, number 1 in the list. That's up by about 0.7%. And then just lastly here, let me pull up JetBlue. That was the worst overall in the list. That's down by about 0.9%. But if there's one thing that customers repeatedly come back to and do comparison on, it's price, Rochelle. So we'll see if any of this perhaps moves the dial in one way or another when it comes down to their own booking strategies in the future, too.
And you never forget a bad experience on a flight, because I know that the holiday kerfuffle for Southwest especially, that they're saying that might cost the company about $825 million. So not only did it cost it like that top spot in terms of best and worst airlines, also hitting their bottom line as well. I remember every bad experience. I still hold a grudge against Continental Airlines. They lost my luggage when I was a kid. I never forgot it to this day.
Rochelle, I 100% second that. I remember which airline I've said the most prayers on, and that has been Spirit Airlines repeatedly in the past.
You never do forget. Great stuff there. Brad Smith there for us. All right, well, before we go, let's take a quick check of the markets. We're seeing that they're actually closer to the session lows of the day. The Dow there off about 340 points. They're losing 1%. The S&P 500 down 32 points, about 0.8%. The Nasdaq also being dragged down there, losing 76 points on the day. I'm Rochelle Akufo. Thank you for joining me. I'll be back again tomorrow at 11 Eastern. See you then.